all of our macroeconomic signals are very bullish on the U.S. economy.
Inflation expectations are very benign.
As long as we get these benign readings, that does still give the Fed some breathing room.
The data may not support an immediate rate hike in September.
September sitting at roughly 50-50.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome to Bloomberg Surveillance. Stocks looking to break out of a two-day losing streak, with CoreWeave and Supermicro renewing confidence in the artificial intelligence trade. Oil rising for a fifth straight day as the IEA warns of tumbling global oil inventories. And traders girding for that key U.S. inflation data coming out in less than 3 hours, with essentially a chance of a coin flip about what it means for the Federal Reserve.
Right, and how high is the bar for the Federal Reserve now, or the CPI report for the market to start pricing in hikes because of what happened last week in terms of a little bit more of that dovish, softer payrolls report, which is why this is really the data point, not just of the week, but it feels like the summer. It's going to set the tone, potentially what we hear from Kevin Warsh at the end of the summer when it comes to Jackson Hole, and of course, ahead of September's Fed meeting.
I like how you put that. How high is the bar? Because ultimately the expectation by economists surveyed by Bloomberg is that core year-over-year inflation is going to fall to 2.4%, the lowest going back to March of 2021. This isn't exactly runaway inflation, and yet the concern is that this is a low point, especially given what's going on with oil prices and the new normal that's creating this difficult backdrop.
Absolutely. We're still seeing this conflict continue. The president says the U.S. has complete control of the Strait of Hormuz. Yes, the United States has a blockade, but we are not seeing the levels of oil go through and transit through the Strait of Hormuz that we were before this conflict. So we have higher oil prices, and as we discussed yesterday, and I think today when you look at what's going on with CoreWeave, Supermicro, the AI build out and that trade, incredibly robust and remains incredibly hot.
Yeah, the fiscal stimulus that's coming from the likes of NVIDIA and Wall Street firms, from Apollo to KKR. A question here about how much it really is assuaging people's concerns when we get the likes of Supermicro and CoreWeave coming out, delivering bigger pipelines than expected. Their shares popping by more than 18% for CoreWeave. A similar type of move on Supermicro. Does it really alleviate some of the worries about how much debt, how much equity they're selling, how much they have to raise money to finance this type of move?
Well, what says is that the demand is there for these companies to have the build out. Do they need more capital to do that? And that's what both of these earnings reports really showed. Also interesting, the one big piece of all of this AI build out that we don't have yet, the piece of the puzzle, is NVIDIA. The end of the month, but both of these companies are incredibly important to NVIDIA and really a bellwether for NVIDIA. So you can imagine they are going to also have a showstopper report.
Well, and you can imagine that they're trying to get ahead of it with this kind of financing arrangement, where more details are sort of coming out over the past couple of days. Right now in markets, you can see that inflection upward in equities across the board, led by big tech following those two earnings reports from CoreWeave and Supermicro, not to mention Tencent out overnight in China. You are seeing the NASDAQ leading. Over in the bond space, an interesting picture where you've got the push-pull of what we're going to get for the CPI print. Pretty high expectations of overheating inflation and, frankly, to be surprised to the downside, short positioning when it comes to treasuries, as well as what's going on with oil. Yet yields are down across the board. Only a basis point. That two-year yield still around that 420 point. The 30-year yield notably down 2 basis points as well. 10-year yields, watch this space, because at 1 p.m. we do get an auction. $42 billion of 10-year notes. And then, of course, in the oil space, not much action. Nonetheless, kind of the stalemate emerging that raises the specter of this being the new normal, with spiking oil prices given what the IEA has said overnight. Coming up, Keith Lerner of Truist as CoreWeave and Supermicro breathe new life into the AI trade. Norges Bank CEO Nicolai Tangen as Norway's sovereign wealth fund posts a record half-year profit. And Veronica Clark of Citi as Wall Street awaits fresh CPI data. We begin this hour with stocks climbing, with upbeat tech easing some of the AI jitters. Keith Lerner of Truist writing, earnings remain our North Star. We remain long-term tech bulls, continuing to see AI as the dominant secular theme driving this market cycle. Keith joins us now for more. Keith, great to see you. How much did CoreWeave and Supermicro tip the needle to optimism from skepticism about financing?
Well, I guess for one day it has, but I really think the broader story is going back during this whole earnings season. What happened a few weeks ago is what we saw, this really strong rebound after tech had corrected double digits. And the big story to me was that we were seeing revenue growth of 20% plus from a lot of these hyperscalers, and especially in the cloud business. So that was, I think, eased as far as the question around, are we going to monetize all this spending? And a lot of the bigger companies were saying, yes, we are seeing that transformation. And then I think, as you said, overnight, this is another positive, saying that there is some monetization. But I would also just be clear that I do think we're in this stage where there is going to be much more winners than losers. We have a gauge of correlations for the S&P, and that's the lowest we've seen in 30 years. So I think that's likely to continue.
When does cash flow matter? I mean, it sort of mattered vaguely for Alphabet. And then when you see what happened with CoreWeave, on one hand, they beat expectations on sales, but their cash flow was much more negative than people had expected, given some of their borrowing and spending plans. I mean, it just sort of highlights how it depends on the day how much this actually matters.
Yeah, we talk about the kind of love-hate relationship with tech, with investors in tech. And I think a lot of times it matters where you're at in the cycle. And back off the March lows until June, the market, tech was up 47%, semis were up 90%. So then you come out with earnings, there's negative cash flow that puts some initial, selling pressure. But I think, listen, zooming back out, I mean, we have this once in a generation build out, and you would expect that there's going to be a lot of spending. And then, there's almost a little bit of, faith that these companies will figure it out and turn a profit. So that's why I think you're just going to see this kind of really high volatility back and forth not over the next couple of months this year, but probably over the next few years, because that cash flow for some companies that have other businesses likely comes sooner than others. But we ultimately think, and again, given the AI bull market, the benefit of the doubt, that these big players will figure it out. They have a history of doing so.
Keith, when you say that the potential is going to be some of these cash flow concerns and questions swirling around cash flow, is that why you think the second half of the year is going to be bumpy, or are there other risks on the horizon that could potentially be annoying for the bull market run?
Yeah, I think there's a lot of the things that we've been talking about. I want to be focused that the primary trend is in place, supported by fundamentals. Valuations this year for the S&P are down about 10% because we've had these earnings overwhelm the PE contraction and these higher rates. But I think there's things we're talking about, oil prices bouncing around each and every day. We still have uncertainty around the new Fed chair, and we often talk about how a new Fed chair gets tested. There's uncertainty around inflation. We got the midterm elections. Historically, just seasonally, that tends to be, a bumpier path overall. But again, even though we think it's going to be a bumpier path, we still think the destination is still higher based on the weight of the evidence, as far as an economy that still is relatively resilient, even in the face of all these things I just discussed. We have earning estimates continue to move higher. This earnings season, every earnings season beats estimates. We know that. But this one, we have 85% of companies beating estimates. We have revenue beats at 75%. And the forward earning estimates for the S&P, for small caps, for mid caps, emerging markets keep moving higher, going back to that North Star phrase that I mentioned earlier.
Earnings, earnings, earnings. So when you look at today and the inflation print, how important is it to you?
It's important for the next 24 hours. I mean, right now, I think you mentioned at the front of the show that the Fed funds futures for September is pricing in basically a 50-50 chance of a rate hike or staying pat. But I'd also remind investors that we have, Jackson Hole in August. We have another PCE report. We have another CPI report before the next Fed meeting as well. And then another employment report. What's also unusual is, the employment report, was negative on the headline. And again, there's a lot of factors behind that. It probably was overstated, but it would be very unusual for the Fed to raise rates historically when we've seen a negative print within 2 months of a Fed meeting. But again, there was some distortion. So I think that next employment report will be saying, like, this is the most important employment report of all time, right? So again, to your question, it will be very important in the near term what rates do and the reaction to it. But there's a long way to go between now and the actual Fed meeting. This
is an increasingly data-dependent market, given the fact that there's not a lot of forward guidance coming from this Federal Reserve chair. I am curious whether you think the pendulum has shifted back to fixed income. For a while, it seemed like equities were very much in the driver's seat with respect to returns. At this point, though, yields have gone up significantly, and there are more questions about perhaps being surprised to the dovish when it comes to both the Federal Reserve as well as some of the economic data. Are you leaning into bonds a little bit more?
So we're still overweight equities overall, but we would be leaning into bonds here as well for fixed income investors. And I think maybe just as a starting point, with that higher income or that carry that we're seeing really provides quite a buffer for investors. We kind of stress tested and say, okay, let's just say that yields move up another 50 basis points on a 1-year forward basis, on a total return basis, if a fixed income investors say buying the 10-year U.S. Treasury, you would still have a positive return. It would be somewhat small, but if instead the market or the interest rates are flat to down, then the upside becomes a lot more attractive. So in our mind, the risk reward is actually improving for fixed income here. We still think, listen, if we have a dovish number, that would probably be better for equities as far as the overall return. But I think we would be leaning into fixed income, at these levels.
Really quickly here, Keith, how much are you watching Japan to understand just how disruptive things could get in the bond market, given the fact that the currency has basically given up a significant part of the intervention, and we're not getting a clear signal on whether either fiscal authorities or monetary policy authorities in Japan will take action on their end?
Yeah, I think it's important. We're also seeing this kind of global yield story, so I don't want to be myopic by just looking at the U.S. And I mean, it's I think it was a couple of years ago where we saw in August the yen cause at least a short-term hiccup in the market. So I think it is important. I think it can certainly add to some swings in the market. I don't think it's the main factor for the overall market. I do think that if it gets, if we see some jitters there, I think that we'll see not only Japan but also the U.S. step in to kind of cool that down. So I think it's going to come ultimately back to earnings and then obviously this Fed meeting in September.
Keith Lerner of Truist, thank you so much for being with us this morning. And AMH, there was a story this morning about the relationship between Scott Bessent and Sanai Takaichi over in Japan. A question around at what point the U.S. will stop bolstering some of the efforts in the currency over in Japan if there are not commensurate measures with hikes potentially from the Bank of Japan sooner and potentially some financial constraints on the fiscal side.
Right. And this prime minister wants to definitely see a growing, productive economy, probably a little bit nervous for the BOJ to potentially hike those rates. But there was a story in Japan over the past 48 hours that it was conditional for the United States, and this is according to their report of Kyoto, conditional for the United States for them to intervene, that the BOJ would have to lean in and saying it was a possibility that potentially as soon as September we could see rate increases.
I wonder how hard the resolve is going to be if Japan truly does start selling down some of their $1.1 trillion of treasuries. Right now, let's get you an update on stories else for this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Good morning, Lisa. CoreWeave shares surging in the pre-market after its earnings showed strong demand for AI infrastructure. The company reporting its fifth consecutive quarter of record revenue and a sales backlog of $104 billion. The International Energy Agency estimating oil inventories will fall at more than twice the rate previously expected for the quarter. The agency's latest report saying crude markets face a shortfall of 1.8 million barrels a day as fighting in the Middle East and shipping disruptions undermine production. And President Donald Trump confirming a report that security officials ordered him to secretly switch planes after the NATO summit in Turkey because of a threat to his safety. The threat triggering an elaborate ruse that saw the president hiding in an airport catering van before being transferred to a different military aircraft. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, claiming control over Hormuz.
Iran is going fine, going just absolutely fine. We have total control over the Hormuz Strait right now. They don't have control. At some point, maybe they'll do something and then they get blown away.
Former Deputy National Security Advisor Victoria Coates joins next. This is Bloomberg Surveillance. Equities trying to snap a two-day losing streak with optimism coming from the AI sector. You're seeing that lead coming from the tech area. In the S&P futures up about 0.3%, getting a reprieve. Broad-based earnings seeming to triumph over concerns about the Middle East. With oil prices, you're seeing oil prices fall just a touch, but still highly elevated, as well as concerns about what the Fed can do. You're seeing 10-year yields down 2 basis points, helping to alleviate those concerns. 4.67% ahead of an auction at 1 p.m. and ahead of that CPI data coming out in about 2 hours' time. Meanwhile, the dollar kind of meandering here. Key focus on the yen after the intervention. When you take a look at the optimism coming from risk assets, CoreWeave and Supermicro really illustrating just how much people are getting enthusiastic about the demand coming for some of these services. CoreWeave in particular, a neocloud being serviced or being rented out to a number of hyperscalers and other companies looking to expand their sales by more than double and expand their services. It's clear, Annmarie, with their shares up almost 19% in pre-market trading, people not exactly writing this kind of story off.
Oh, definitely not. And I think two of the most important numbers, the backlog that everyone looks at, that was at $104 billion at the end of the quarter, and they inked more than $25 billion in new customer commitments after this period ends. So the rest of the year is looking, at least next quarter, is looking pretty bright for CoreWeave.
And this gives to the optimism despite the uncertainty ongoing in the Middle East. Under surveillance this morning, claiming control over Hormuz.
Iran is going fine, going just absolutely fine. I'm the last person to trust Iran. They've lied to me constantly. We have total control over the Hormuz Strait right now. They don't have control. We have total control. We own it. And at some point, maybe they'll do something and then they get blown away.
Here's the latest. Brent crude whipsawing after 5 days of gains as the diplomatic standoff between the U.S. and Iran dims hopes of a deal on the Strait of Hormuz. Bloomberg's Tyler Kendall joins us now. What's the latest in this area?
Hey, Lisa, good morning. Well, there are some signs that diplomacy is underway, but at least publicly, the two sides are digging into their positions. As you heard, President Trump says that the U.S. has control over the Strait of Hormuz as the military does continue to enforce its naval blockade. We heard from the U.S. Energy Secretary Christopher Wright yesterday, who said that the 7-day average for flows out of the strait is sitting around 9 million barrels per day, though that is higher than most traders' estimates. As new overnight, and you mentioned at the top of the program, we heard from the International Energy Agency saying that global oil inventories will tumble this quarter more than twice the rate previously estimated. Because at this point, there's been very little indication Iran is backing down from its threats to global shipping, not just in Hormuz, but new today. We got confirmation from Yemen's government that at least 6 people have died in a Houthi attack in the Red Sea. That includes 3 Pakistani nationals, as we also got confirmation that Pakistani officials are in Iran to continue these negotiations, but we've got very little indication on what a potential breakthrough will look like. Lisa, a senior U.S. official, does tell us that at this point, President Trump is not in a rush to make a deal, saying that he is confident that economic pressure as well as factions within the Iranian government will ultimately lead to the country tipping its hand.
Tyler, I'm also curious, just briefly, the story that seems to be gaining steam about President Trump sneaking out of Turkey onto a plane that was not Air Force One on a food delivery truck. What the significance is of this? Yes, it would make a great scene in a movie, but on a broader level politically, why is it gaining so much steam?
Lisa, there's so many threads that we could pull on this, one including that it underscores the threat assessment that the U.S. government currently has when it comes to President Trump's safety amid ongoing threats from Iran as the conflict continues to drag on. We did hear from President Trump yesterday deflecting criticism about this remarkable reporting that Air Force One, filled with White House officials and journalists, was essentially used as a decoy to help get him out of Turkey after the NATO summit, coming just days after the U.S. decided to continue to strike Iran amid attacks on shipping in the Strait of Hormuz. I grabbed the quote. President Trump told reporters, quote, "I do what they say," in reference to the Secret Service and the military that essentially demanded him to swap planes. Lisa, we should add, Bloomberg has not confirmed the details of the Post reporting, though it is raising these broader questions, including the safety features on that Qatari jet that President Trump would like to use as his main mode of travel.
Tyler Kendall, thank you so much for that. We'll see you in a bit. To build on this conversation, former Deputy National Security Advisor Victoria Coates writing, "I think there's every reason to believe that Iran will blink first for the simple reason that they're running out of money. This isn't about them feeling pain. They're well past that stage." Victoria joins us now for more. Victoria, thank you so much for being with us. I want to start on that story of President Trump getting snuck out of Turkey on a food delivery truck. What do you make of this in light of some of the threats on the president's life, as well as some of the unprecedented nature of some of the moves that his security staff have taken?
Well, good morning, Lisa. Good to be with you. No, this is a very obviously sobering story, and it does. I mean, as Tyler was reporting, it sort of has every element of drama in it. So of course, people are talking about it. But the fact of the matter is, whoever leaked this is, I mean, essentially committing treason to try to make the president, look like he's in danger, look like he's weak, and he's not. I mean, it's not that this sort of thing happens all the time, but it does happen. And I mean, just one technical point, that plane is no longer Air Force One if the president isn't on it. Whatever plane the president is on is Air Force One. So that plane no longer was. The idea that it was decoy is also sort of ridiculous. When you work for the president or when you opt to travel with the president, it is made very clear to you that your safety is secondary to his. And it is an honor to be able to have those opportunities. But it's very clear that the priority of the military and the Secret Service is going to keep the president safe. And that's what they did. And I'm glad for it. But it also is a very stark reminder of who our enemies are and that he is constantly in danger.
So I'm not sure if it shows that he is weak. It shows that there was likely a credible threat in his life. Do you agree?
Oh, absolutely, Annmarie. Yes. This whole thing, he ducked into a catering truck. I mean, it's all over. Former Biden administration officials are sort of tweeting about this and how it makes him look old and foolish and weak. It doesn't. I mean, this is a very professional organization, the Secret Service, and their priority, as I said, is to keep the president safe. And I'm glad that they did it.
If the threat of his life was so severe that he had to do this, is it appropriate for the president of the United States to put his staff and other Americans, the press corps, and other individuals like members of the Secret Service, staff of Air Force One, in danger?
Well, I don't think he put them in danger. I think if they were in danger, the Iranians put them in danger. And as I said, Annmarie, and you know this, you've traveled with the president. Everyone makes it very clear to you that your safety is going to be subordinate to the president's.
But traveling with him, we know where he is also at all times. The press was not briefed on that.
Necessarily true.
Well, you see him enter a plane, you see him exit a plane. The press were told specifically that they need to shut their blinds during this.
Oh, right. I mean, I flew into Baghdad with the president in 2018. We kept our blinds down from Germany to al-Assad. I mean, that's not unusual.
Victoria, I am curious about the state of play right now, what we're seeing in Iran and what the stalemate is that people keep talking about. Do you see anything emerging that is a path to evolve out of this stalemate? Or is this an acceptable kind of new normal to bleed the Iranian economy, given what you were saying before, which is they're well past the point of just feeling pain?
Right. And I mean, I think it's really important, Lisa. I mean, nobody should have any illusions that the Iranian regime cares one iota what is going on in the country in terms of the pain to their people. So, when we think in the United States about, we really don't like people paying $5 a gallon for gas, we're going to take action to try to mitigate that. Nothing like that's happening in Iran. They don't care. But what they do care about is their ability to keep paying the IRGC, that 1/3 of the Iranian military that's particularly loyal to the regime. They want to be able to keep paying the Basij, which is their security force in country, Chinese trained essentially to keep control of the Iranian people. When they start to run out of money to do that, they're going to have a real problem. They're already cutting back on food subsidies, energy subsidies. And, that's going to cause a lot of unhappiness among the Iranian people. But the core thing is they're being able to keep paying their control apparatus. If they run out of money to do that, and that's where they're headed at this point, then they really might lose their grip on the country. And I think that's what everybody really would like to happen, to have a sort of systemic leadership change in Iran, hopefully a managed process, a little bit more like a Gorbachev process, if you will, rather than another 1979 chaotic revolution. But that, make no mistake, that's what's happening to them. And there's really nothing they can do to reverse that, absent significant assistance from the outside.
Former Deputy National Security Advisor Victoria Coates, thank you so much for being with us this morning. A real question about the battle of which potentially will be the pain point that gets hit first, either what's going on with Iran or the barrels of oil that are getting depleted from some of the stockpiles globally.
And when it comes to negotiations, I was reminded recently there's a reason why the JCPOA took 20 months. And not all of it was because the material was so hard to negotiate. Give the Iranians an inch, they take a mile.
Coming up, we're going to be talking with Norway's Nicolai Tangen as the country's sovereign wealth fund posts record returns. That's coming up next. This is Bloomberg. Stocks regaining momentum on the heels of better than expected tech earnings. We're seeing that pop really come through the tech-heavy NASDAQ index in particular, up now 0.7%. We're seeing up 30% on the S&P and 0.2 on the Russell 2000. Some of this optimism is also coming from the bond space, 2s, 10s, and 30s, seeing a bid into bonds, with some people saying maybe this has gone too far. Yesterday, we actually did find a buyer for 30-year treasuries, so maybe that was a sign of what's to come. Down 2 basis points on the long end, 1 basis point on the front end, ahead of what we're going to be getting at 8:30 a.m. Eastern time, which is that U.S. CPI print. More importantly, though, what is going to happen with oil? Because right now it is quiet there, quiescent when we get this sort of sense of a stalemate. That could change, as we saw yesterday morning, very quickly. 3 hours away from the cash open, here are your morning movers with Vonnie Quinn. Vonnie.
Well, Lisa, there's a common theme with all of our movers today, and that, of course, is the massive and robust AI build-out. So let's start with Supermicro Computer, up more than 8% in the pre-market. It delivered strong and gave a forecast that beat estimates. A huge mismatch between what the street was expecting, what investors were expecting, and what Supermicro actually delivered. And as you can see, getting awarded today. Now, Supermicro obviously in a great position to be able to deliver NVIDIA-powered servers into the market right now, which is very, very cheering to this market. If you look at our next company, we also have a neocloud. CoreWeave, it's one of the few neoclouds that are publicly traded in this market, up 18%. Now, obviously, this is a massively volatile stock. Sometimes it trades like a meme stock. But for 5 quarters in a row now, it has beat revenue estimates. The only thing is, the previous 4 quarters, the stock actually plunged after the earnings report. This time, investors are rewarding this company. It's back on an upswing, having had several weeks of being on the downward slide. And it seems to have just really gained investors' trust once again. Expect a halo effect on some of the other neoclouds after that. And then we look across to South Korea, and as you can see, ADRs already trading higher. In the Korean session, SK Hynix was up 5.5%. I know you're speaking with the Norway Sovereign Wealth Fund CEO Nicolai Tangen. Well, in Singapore, Temasek, which is also quite well regarded, reports were that they are planning to invest more in SK Hynix and also Samsung. Bloomberg News got in touch with Temasek, and it said it already invested in some of these companies 2 years ago for the first time, and it doesn't actually look to the South Korean government for any advice on when to invest in SK Hynix or Samsung. But certainly we're at levels now, having had that sell-off in South Korea that SK Hynix was at last back in May or even April, so it might be a good time for the Sovereign Wealth Fund to get in, and of course that's causing the stock to rise as well, with lots of trust in this company. Lisa.
Thank you so much, Bonnie. On our radar this morning, CoreWeave shares surging. The computing company boosting its outlook and reporting a backlog over $100 billion. That's in addition to more than $25 billion in new commitments for the third quarter. Global oil inventories plunging at more than twice the previously estimated rate. The IEA's monthly report finding a 1.8 million barrel per day shortfall, driven by the recent flare-ups between the U.S. and Iran. Not moving much on the crude space. President Donald Trump confirming he covertly switched planes last month, departing the NATO summit in Turkey.
I go by Secret Service and the military. They wanted me to go on a different flight, a different plane, equal safety, but they wanted me to do it, so I do it. I do what they say.
The president making the switch from the new Qatari-gifted Air Force One to the original model after assassination threats from Iran, being transported from plane to plane in the airport's food catering truck.
There's a lot of questions surrounding this. Also, if there was a real credible threat on the plane that the president did go up the stairs for before he was snuck out, then why wasn't individuals on that plane alerted? And why potentially did that plane even take off? As you can imagine, the Democrats in Congress want answers. I imagine some Republicans too. Senate Democratic leader Chuck Schumer said the Senate should be immediately briefed on the Iranian threats against the president, the extraordinary measures taken to get him out of Turkey, any risk posed to U.S. personnel, any threat to the homeland. We also need to understand how serious is the credible threat to the president's life right now by the Iranians, because this story is not going away.
Yeah, and something that clearly is simmering given the stalemate conversations that people keep having. This is the backdrop as you see oil prices kind of hovering near people's minds as they look ahead to the CPI print at 8:30 a.m. amid otherwise a really optimistic feel in markets. Norway's $2.3 trillion sovereign wealth fund posting a record first half of the year with a return of more than 9%, gaining $185 billion. The results following a stark warning from Nicolai Tangen, the CEO of Norges Bank Investment Management, which supervises the fund, that its entire value could potentially vanish in a future market crash. Nicolai joins us now for more. Nicolai, are you feeling good after a quarter, after a half of a year like that? Or are you feeling more bearish that potentially this is luck and could potentially all disappear with the snap of a fingers?
Well, it's a combination of the two, I guess. The first half was very, very strong results. Actually, the biggest in monetary terms we ever had. And of course, after a rally like that, you're a bit more nervous, a bit more conscious about all the dangers out there.
At the same time, are you seeing sort of peak returns right now, given some particular risk that you're worried about in the second half of this year? Not necessarily like a catastrophic market disruption, but just whether it's inflation, whether it's concentration risk. Is there something on the horizon that's giving you pause about just how good it can get going forward?
Well, it's a combination of several things. I mean, the fund has had an extraordinary backdrop for the last 30 years since it was set up. It's doubled over the last 4 years, right? So these are just incredible return numbers. And we are seeing a lot of reasons to be really cautious. We are seeing, AI valuations. We are seeing geopolitics. I think there are a lot of reasons to be cautious going forward.
Almost 55% of the fund is now focused on U.S. investments, and a lot of people have raised concerns about diversification risk. You've said that there are limited options to really deal with this concentration risk. However, on the margins, are you looking for ways to diversify, concentrate more significantly in Asia, or offset some of the risk tied specifically to the United States in a more significant way?
Well, it is very interesting. The concentration risk is now such that the largest 10 holdings only account for nearly 25% of the value of the fund. And so we've never seen a concentration risk like that. We also saw, for instance, in the first half, the 10 biggest contributors to the gains. Of those, 9 were related to the chip sector. Then there is an ongoing kind of process taking place now in Norway where they are looking at potentially diversifying the fund. And so there is a process going on there, and we'll see where we end up.
You said in the past 24 hours, I want to contribute to our mental emergency preparedness by asking the question, can the oil fund disappear? What are you preparing for potentially? You basically are saying the entire value of this fund could vanish if the market crashes.
Well, it's interesting. It's just that when you look at history, no national wealth has ever lasted. Big accumulations of wealth, they always disappear. And we just need to be prepared for a day where the value of the fund is lower. And so expectation management is an important part of what we do, and that's what we're doing now.
Right. So as you prepare that portfolio for potentially this, maybe a black swan event, what you're concerned about, how are you hedging?
Well, so that's the thing. When you are a very large fund like we are, we own between 1% and 2% of all the equities in the world. There are limits for how you can hedge this out. And also, of course, over time, a very good place to be invested is to be broadly diversified across the world. And so that's what has been the reason for the success historically, and is how we're going to run going forward. But when you are fully invested like we are across the world, you also need to be conscious of the fact that, things go up and down, and it's important to signal that to investors and the other stakeholders of the fund in Norway.
Nicolai, you said that you're conducting a review for how to diversify potentially away from U.S. concentration as well as AI concentration. What are some of the options on the table?
Well, there are a whole range that you can diversify. I mean, as I said, this is a process taking place now, and one of the reasons why the fund has been great is because the main decisions are broadly anchored amongst the political parties, and this is then a process that has been started, and we'll see what comes out of it.
One thing that you've been really vocal about is the deployment of artificial intelligence within the fund to help with decision-making, reviews of QSIPs, given the fact that it's a $2.3 trillion fund. It's quite large, and I imagine that you can benefit significantly from the efficiencies of scale. How significantly has it changed the way that you do business and, frankly, the returns, just the capital expenditure that's required for portfolio management?
Oh, it's been huge. It's been incredible. I mean, we have a podcast where we interview the leaders of the main companies in the world, and we very early on had the leaders in the AI industry, and we realized just what an incredible thing this was. And so we 3 years ago started big time implementing it with pressure from the top, the people we recruit, an ambassador system, forced training, central AI team, and so we are all over it. And I think we, over the last year or so, have increased productivity by roughly 20%. It has helped us decrease trading costs and so on. So it's just amazing what it's done to the way we operate.
Nicolai, does that make you more optimistic about the returns from some of these artificial intelligence-related companies, investments, even just the broader market, based on the efficiencies they could also reap from this technology?
Yes, for sure. I mean, it has led to a deeper understanding of what this technology can do. We can see why these companies are performing really well, because there is such a big part of society which hasn't even started on this transition. So that's for sure very optimistic. And I also think it is a deflationary force which will be positive for markets and has been positive for markets.
When do you think we'd actually see that deflationary force come into play? Because right now, in the short term, a lot of people say this is incredibly inflationary.
Absolutely. It is inflationary now. I think it will be deflationary as you get more knowledge for free, you get just efficiency in your workforce. And then, of course, you have the humanoids and the robotics coming in, over the next few years. I think it's going to be fantastic. I mean, just look at all the boring stuff we do every day. I mean, what is leading to divorce? Who is going to empty the dishwasher? Who is going to take the rubbish out? All these kind of things. We are just not going to discuss it anymore.
Okay, so AI potentially is very good for also individuals' home lives. But
Totally.
When you say potentially it's deflationary in the long term, do you think then central banks around the world could potentially wait it out?
I think that's a very important question, and it remains to be seen whether they are going to wait it out and accept more kind of temporary inflation, waiting for this or not. I think it remains to be seen. It will be very interesting to see what the various central banks, how they're handling this.
I do think that probably people will still argue about who does the dishes and potentially who takes the rubbish out. I am curious, though, about whether your belief, this being disinflationary, to build on what Annmarie was talking about, is enough for you to feel more okay with the glut of debt being sold to the long end of the yield curve, not only from governments around the world, but also some of these hyperscalers. Do you want to be a buyer of that, or does it start to concern you?
We have, for a long period of time, been concerned about the high debt levels in society among some of the larger countries in the world. It is a real worry. You never quite know when enough is enough. But at some stage, there is a danger that people suddenly would want to be more compensated for taking on more of this debt. And so that's another of the things that we are really looking at.
To just sum up, Nicolai, do you ever expect a half of a year like the one that we've just seen with respect to returns for the Norwegian Sovereign Wealth Fund?
No, I think this is as good as it gets.
Nicolai Tangen, thank you so much for being with us this morning. Nicolai Tangen, Norges Bank Investment Management Chief Executive Officer, on how artificial intelligence will save marriages worldwide.
Right. So I think you're right, though. Potentially, people would just argue about who is going to tell a robot to take out the rubbish, etc. Interesting point there at the very end. As good as it gets, he thinks that's where we are right now. Maybe in terms of the earnings, but maybe he's seeing it can get even better when it comes to things like your relationships.
Well, the irony here is, for a long time, people were saying markets are not the economy. Markets are not the economy, and markets were far ahead of where economic growth was when it came to just the average rank and file. Is that switching? Are we seeing maybe the momentum in equities lose steam in favor of the economy catching up? And at what point do we end up seeing that dynamic take hold?
Well, I think that's the big question, especially when you talk about, as Nicolai was saying, about this disinflationary impact of AI. When is it? When will you actually start to see it?
Great conversation. I think I should really think about that robot. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, Bank of America announcing $250 billion in an initiative to invest in critical infrastructure across the United States. The investment is intended for projects including data centers, renewable power generation, and energy storage. It aims to support energy security, job growth, and economic competitiveness. In Wisconsin, moderate Democrat David Crowley is projected to win the gubernatorial primary. Decision Desk HQ says Crowley has 39.8% of the vote, compared to his opponent, Socialist Democrat Francesca Hong's 39.38%. Now that's all with more than 95% of the expected vote counted. And Decision Desk says 2020 election denier and MyPillow founder Mike Lindell is projected to lose Minnesota's Republican primary for governor to State House Speaker Lisa DeMuth. His loss follows an endorsement from President Donald Trump. And that is your Bloomberg Brief. Lisa.
Thank you so much, Bonnie. Up next, depending on the data.
The Fed has some time to assess the next move, so one data point alone isn't going to be enough. The reality is the market is going to continue to price in hikes for now.
Veronica Clark of Citigroup, not one of those, and she joins next. This is Bloomberg Surveillance. Good morning. Just 1 hour and 42 minutes away from the key data point of the week, CPI in the United States. Right now, markets seeing some room for optimism, with both potential for disinflation on one side, with also the potential for some really good earnings from tech companies. S&P futures up 0.3%. We're seeing right now yields lower by 2 basis points on the 10-year, which is notable, 4.67% rounded up. A real question heading into the $42 billion of 10-year notes being auctioned today at 1 p.m. Eastern, and Brent crude getting a little bit of a breather, but still a real rally over the past couple of weeks as we've seen the conflagration continue to simmer under the surface. Right now, we are about to get that data just less than 2 hours away, with a real question about what it means if we do get core inflation coming in at the lowest rate since March of 2021. Under surveillance this morning, depending on the data.
It is an economy that's overheating to the extent that the Fed needs to be taking aggressive action. Inflation expectations are very benign. The Fed has some time to assess the next move, so one data point alone isn't going to be enough. The reality is the market is going to continue to price in hikes for now.
Here's the latest. Boston Fed President Susan Collins telling the Financial Times she would back a rate hike next month as long as inflation remains high. Traders pricing in a roughly 50% chance of a hike ahead of today's CPI data due at 8:30 a.m. this morning. Veronica Clark of Citi writing, upcoming CPI releases should make it clear that inflation measures continue to ease and are not far from levels consistent with the Fed's 2% target. Veronica joins us now for more. Veronica, great to see you.
Good morning.
The alphabet soup, it actually matters right now, because when we talk about disinflation, it's coming in certain areas more than in others. And in the Fed's preferred measure of core PCE, even if this is a weak reading, we could potentially get hot components going into that. How are you looking at today's CPI print?
Yeah, it's a really interesting one because we have seen a lot of disinflation in CPI for a while already. I think it's 14 of the last 15 readings have been at or below consensus for core CPI. But yeah, you're not seeing that in PCE. Of course, we'll take all the details and add it all up and see what we get for PCE. But I do think it's true, and it has been true for a while, that core PCE is a bit the outlier. Even if you look at some other measures that use PCE data, the trimmed mean, the Cleveland Fed median PCE, those are all pretty consistently slowing. They're not far from where they were in 2019. And then we do have to remember that PCE is going to get some big revisions in about a month. And so I do think it's important to take with a grain of salt the signals that we're taking from core PCE right now.
Yeah, which some people are raising some issue with. Does it matter where inflation's coming from?
Yeah, of course. And it is interesting, this divergence between PCE and CPI. And the fundamental way you can kind of read that is CPI are the goods and services that people are spending on out of pocket. So if that's telling us something about consumer demand, we're not really seeing the inflation there. The sticky elements of PCE are the things that might get revised. They're the imputed prices. They're things like medical services, which the government or insurance pays for. So if you're trying to see what are those consumer demand pressures on inflation, CPI is maybe your better measure, and you're not seeing it there.
When it comes to the oil aspect of all of this, a lot of people thought potentially we would have a reprieve. We wouldn't still be in this conflict. At one point, does this really start to become entrenched?
Yeah, I mean, we've obviously seen the energy prices, those input costs rise. What we haven't seen yet is that passed on to the final consumer prices? You see it in some things like airfares. You do see inflation expectations that stay relatively anchored, certainly market-based measures. So I think that's a positive for the Fed if you started to see those rising. But I think for now, the dynamic is that you do see real income growth slowing. People are obviously spending more on gas and whatnot, and that means less to spend elsewhere. And so you're not really seeing it entrenched in those other prices yet.
What about the fact with the AI build out, we are seeing higher energy costs, higher construction costs, higher component costs when it comes to chipflation?
Yeah, those are actually some of the components that are going to get revised in PCE, right? So we have to see what that happens. In some of the details of this CPI data, I am looking for, computer prices, if those are higher. We had some recent announcements of some price increases there. But that's not really indicative of this broad-based inflation, that demand is too strong relative to supply kind of inflation that the Fed should care about.
It seems like we've reached some sort of stalemate over in the Middle East. That could change, but right now that's what we're hearing around the edges. And it seems like people are expecting oil prices to remain around here, maybe inflect a little bit higher, potentially even going as high as 150 at some point, but not to the point where you end up seeing the demand destruction that was kind of the curtailing factor earlier in the summer. How do you price that in? Does that change your view if this is the new normal?
Yeah, it's really hard to know. I mean, we have not seen the pass-through yet, right? What I'm ultimately focused on is what does that do to final consumer selling prices? And yeah, we have not seen that pass-through yet. Maybe it just takes more time, and if people come to expect that prices remain high, then they will pass on more of that. But businesses, as much as they might want to raise prices, it does depend on their ability to and the ability of consumers to pay more. And I think that's what we have not seen yet. You see that in some survey data, which is even very different than last year.
At the same time, we have seen the pass-through when it comes to airlines and the fares there. We have seen pass-through when it comes to all of the hotels and cruise lines and everyone who's been reporting who've been able to offset the increases in base costs. I'm looking right now at diesel. It's at $5.36 right now on average, still incredibly elevated. I mean, isn't it possible that this actually does have an ongoing effect that takes away what we saw in the prior reading?
It's absolutely possible. Yeah, we might just have to wait longer. Maybe it's that businesses have to, draw down the inventory that costs less to ship, and the more expensive inventory at some point, starts to show up on shelves. That's kind of what we saw with the tariff effects. But so far, we haven't seen that. And I do think what we can say about, airlines, right, airfares, for instance, is this is a very different pass-through than, say, even 4 years ago, right? Consumers just much less positioned to be able to withstand those higher prices now.
Veronica Clark, wonderful to see you. Thank you so much for being with us today. Veronica Clark there of Citi. And this is sort of what people are looking at, is if this is the new normal, the inputs at some point will either bite or people will stop buying as much, and that will lead to a slowdown in growth.
Boston Fed President Susan Collins was talking about this with the Financial Times, especially in her region. Of course, higher crude prices means higher heating oil. That is incredibly important for the winter in New England and also potential electricity demand. So she is saying she is seeing those rising costs right now, and it's businesses and consumers that are coming to her and saying inflation is just too high.
At the same time, we did see the NFIB small business optimism survey come out yesterday at an 11-month high. So the push-pull continues. The higher oil prices definitely hitting more in Europe, with yields that have been climbing significantly more. And the reason why an increasing number of people still are looking at the U.S. as the place to be, simply because the offset is greater in terms of growth. This is a much bigger problem with Europe, especially with the heat, especially with the drought. And now everyone's talking about the solar eclipse.
Yeah, everyone is talking about the solar eclipse. I'm not sure if that's a problem right now exactly for Europe, but they are definitely more vulnerable when it comes to higher energy costs.
Yeah, well, the solar eclipse, it prevents them from getting solar energy for a couple of hours, or at least a couple of minutes. Coming up in the next hour, less of that, more of this. Yardeni of Yardeni Research, Jessica Taylor of the Cook Political Report, Amanda Lynam of Goldman Sachs, and former Philadelphia Fed President Patrick Harker. This is Bloomberg Surveillance. Good morning.
We're seeing this really concentrated growth, really concentrated investment in AI.
AI is a place you need to be selective.
It's not just the Max 7 and the hyperscalers that are driving the market.
Volatility is relatively muted.
A lot of the momentum in July has come back into the market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to the second hour of Bloomberg Surveillance, with stocks holding on to gains as corporate earnings continue to deliver. Oil the sticking point Prices fluctuating this morning in the face of a potential stalemate in the Middle East. Questions about who holds it right now in terms of the power. And the U.S. CPI report due in about 90 minutes, with traders pricing in the chance of a September rate hike, is essentially being a coin flip. And frankly, the view on exactly how important this inflation read seems to also fluctuate guest by guest.
That is very true, but it's also because we're going to get a number of other data points before the Fed meets in September. So we really need to see by the end of the summer, and after, of course, we hear from Kevin Warsh at Jackson Hole, which I know you'll be at, then probably understand a little bit more of what the September Fed meeting actually looks like. But it was another day when you heard from another Fed official when it comes to Susan Collins having this concern about what consumers and businesses are telling her and individuals in her district about just that they are concerned about inflation and prices are just too high.
On the other hand, we're expecting core inflation to come in potentially at the weakest going back to March of 2021. People are talking about how, depending on the metric, we are getting closer to the Fed's target. So here comes the question. Is it just a matter of time that we're running out of it to get back to that target after more than 5 years? And that is going to be enough for Fed officials to really make a move in September, especially given the ongoing pressure coming from the oil space.
And as you mentioned the last hour, what the IEA had to say in terms of the inventories being drawn down around the world. If this continues in terms of the conflict, and we are losing those barrels every single day coming out of the Strait of Hormuz and relying on those inventories, potentially you're going to see higher prices.
I love that chart. CPI, PPI, PCE, CPI, PPI. It's hard to do. It's good nursery rhyme. Right now in markets, you can see a sense of optimism coming through after what we got yesterday with CoreWeave and Supermicro, led by that tech sector, up 0.7%, up 0.25% in S&P futures. In the bond space, interestingly, that disinflationary hope and dream coming to play a little bit, although fading throughout the morning. A bid into bonds, even at the long end, ahead of the auction later today. 10-year yields 4.67, 30-year yields 5.22, that 2-year yield hovering around the 4.2 level. And in the crude space, blink and you'll get another direction this morning. It seems to be hovering, fluctuating between gains and losses, $88.98 on Brent and $83.36 on crude. Coming up this hour, the biggest bull on Wall Street at Yardeni of Yardeni Research as stocks look to snap a 2-day decline. Amanda Lynam of Goldman Sachs, NVIDIA eases AI debt concerns, and former Philly Fed President Patrick Harker looking ahead to today's CPI report. We begin this hour with stocks gaining as the AI spending boom lifts CoreWeave. Ed Yardeni of Yardeni Research raising his year-end S&P 500 target to 8,400, remaining the most bullish on Wall Street, writing, AI demand looks real to us, but its skyrocketing growth will decelerate eventually. When it does, investors will likely stop pricing AI as one trade. Ed, I am so glad to say joins us this morning. Ed,
Thank
great
you.
to see you. So let's start there.
Sure.
This is something that we were struggling with a little bit with Nicolai Tangen in the last hour, where on one hand, he's bullish AI and seeing a lot of productivity gains.
Sure.
On the other hand, he's saying this is as good as it gets when it comes to market returns. Do you feel the same way?
No, I think the market's going higher, and I think it's going higher on earnings. As a matter of fact, I felt the need to coin a new acronym, which is FEMO, Fabulous Earnings Momentum. We all know about FOMO, which is kind of, it's nice while it works. FOMO is fear of missing out. We saw that in the 1999 melt-up situation is don't bother me with earnings. I just have to be in this internet concept. And this time around, the valuation multiples kind of stuck around 20. That's not low, but it's not terribly high as long as the economy is growing. But it's earnings that have really been phenomenal. And some of that has been mark-to-market capital gains on SpaceX for Alphabet and Amazon. But take that out and you basically have 25% increase in earnings in the second quarter and about the same in the third and fourth quarters. So yeah, I've been bullish on earnings, but not bullish enough.
That seems to be.
Analyst, you said I'm not really the bull on Wall Street. It's all these analysts who talk to companies, and the companies are bullish.
So the companies are the big bulls on Wall Street, not Ed Yardeni. I am curious, though, about what we have seen with performance of the equal weight versus the market cap weight. And that has been a shift this year versus previous years, where the outperformance has come from the broader market. We were talking before about how the market seemed to be outperforming the economy for a number of years. Is that shifting, or now we're going to see the economy, the rest of the economy, outperform the market?
Well, there's sort of a view that the stock market is not the economy, but it is, because it's PE times Z, and E is earnings, and earnings are driven by the economy. And so I think the resilience of the economy, the strength of the economy has been demonstrated in the earnings, and the earnings are driving the the stock market higher. So with regards to your point on, I call them the impressive 493. You know, you have the Magnificent Seven that did very well for quite some time, and now they've actually, so far this year, significantly outperformed the impressive 493. And I think it's because people have AI fatigue. It's like, oh God, I can't really figure this out anymore. You know, these stocks go up 20 bucks, down 20 bucks. And so I think people are just kind of taking an index approach to AI, not knowing exactly which stock to buy. And meanwhile, they say, well, who's the sure beneficiaries? And I think they're finding lots of ideas in financials and healthcare and industrials that are very, you know, we understand their businesses, and we also know that there's a good chance that AI could help.
When you talk about going up $20, going down $20, this is exhausting, this sort of single name volatility. Is that part of a problem with respect to the amount of leverage that's being used in specific sectors and specific funds? And I'm wondering, even just with the debt profile and the investment that's going on, a lot of this is coming with leverage. Does that worry you?
Not terribly, in the sense that this is not a new development. We've always worried about margin debt. We're always worrying about credit. And rightly so, because the credit markets tend to see problems before the stock market. And we saw that certainly in 2007, 2008. So the debt is always an issue, especially if it goes bad and you have a lot of defaults, and then you get a credit crunch, and then you get a recession. I don't think that the problems in the debt markets, we're seeing the hyperscalers bond yields of the spreads over treasuries have widened a bit, but they're still able to raise money. And now NVIDIA came up with this idea that let's call in all these top financial people from the Hamptons, put them in the Hamptons jitney, bring them in, and to talk about $500 billion of financing. So, NVIDIA basically said, okay, you're worrying about financing? Watch what we have to say about how we're going to do $500 billion. I don't know. It was a little hype. I mean, it was, it was all done with a memorandum of understanding, and we know how well those things are going these days.
I love that you think they came in via the jitney, but what's funny about this is that if you think that is hype, and that's basically just NVIDIA trying to basically quell some of the concerns out there in the market. Then does that make you a little bit nervous, actually?
Well, I think that AI is a fundamentally important technology. It's not a revolution. It's actually an evolution of the digital revolution that started in the mid-1960s with IBM mainframes. And the whole point of the digital revolution is to process as much information as we possibly can, as fast as we can, as cheaply as we can. AI is just the latest progression of that. Next will be quantum computing mixed in with AI. And there's a lot of positives in all that. There's negatives. Some companies will flourish. I mean, for a while there, people thought, cybersecurity is software. Let's get out of the software. Let's get out of cybersecurity. And then all of a sudden, they come right back in, realizing that as AI gets "quote unquote" smarter and smarter, we're going to need more and more cybersecurity protection.
You say in your note that you've been bullish on earnings, but not nearly as bullish as the recent consensus of industry analysis, and that's what you said to us as well this morning. So is your price target even high enough for you? Do you think you're going to have to come back and reprice?
It's possible. I mean, look, I was thinking that the market would be discounting $375 a share at the end of this year for next year. Now I've raised that to $415 a share for next year. And so by the end of the year, if the analysts are still talking about something like 415 for next year, and they're already talking about 408, so we're getting there. 415 times a little bit over 20, and you get my new target of 8,400. Now, I did keep my 10,000 for the end of what I call the roaring 2020s by the end of 2029. Even I get kind of confused about the decades here. But we're in the 2020s. It's gone well. And I think by the end of the decade, we should be looking at 10,000. I'm not raising that, but I might.
How much is inflation a constraint? And by inflation, I don't just mean the CPI print that we get in about an hour and a half, but also what that does to bonds, given all of the spending globally.
Well, look, the CPI is widely expected to be on a core basis up 2.5% year over year. It's important to realize that the consumption deflator, which the Fed tends to watch more closely, according to the Cleveland Fed's now inflation forecasting, that's expected to run like 3.3%. So the Fed Chair Kevin Warsh came in June said, "I am committed to price stability. We've had inflation too high for too long, over 5 years." In July, he said it again, and the bond market seemed not particularly satisfied with that because it's like, what are you waiting for? So maybe he's waiting for the CPI, maybe he's waiting for, as you said, there's a lot of data that's going to come out.
Yeah, I am curious, though, about the bond vigilantes, which you coined. Yeah. Are they back when it comes to the 30-year note?
In Japan.
Well, they're coming back globally, given the fact
they're coming back globally to a certain extent. You know, I don't really get freaked out by bond yields between 4 and 5%. The 10-year between 4 and 5% in the U.S. And the reason for that is, people keep talking about higher for longer, implying that the rates should go down at some point, that they're too high. This is normal. 4 to 5% is where we were before the great financial crisis. It's where we were before the inflation of the 1970s. I think it's a testament to the fact that the economy is doing well, and 4 to 5% is an indication of that.
Ed Yardeni, wonderful to see you as always. I can speak with you all morning. Ed Yardeni of Yardeni Research here in New York. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. President Donald Trump says the U.S. has total control over the Strait of Hormuz and that Iran would get blown away if they took action. Trump's comments coming after Pakistan's defense minister told reporters in Islamabad that the two sides were close to some sort of arrangement over Hormuz. Shares of Tata Motors falling in Indian trading. Tata Group's chairman announcing he'll step down when his term ends in February of 2027. The decision follows a nearly 12-month boardroom battle with Noel Tata, who wants his son to play a more prominent role in the company. Supermicro shares up more than 8% in the pre-market. The company forecasting quarterly revenue that beat even the highest analyst estimate, also raising its full-year outlook, citing continued demand for AI infrastructure and its NVIDIA-powered servers. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, gearing up for November.
I have been telling you that this campaign was about the many versus the money. Well, guess what? The many just won.
Jessica Taylor of the Cook Political Report joins next. This is Bloomberg Surveillance. Good morning. After speaking with Ed Yardeni, it seems like everyone's getting a little bit more of a boost in the equity space. As what we're seeing right now, a lift snapping a two-day spree of losses. Right now up about 0.25% on S&P futures. Seeing yields lower down by 3 basis points almost in the 10-year, 4.66%, as we do get that data coming out in about an hour and 15 minutes, U.S. CPI. The expectation is that core is going to come in at the lowest level since March of 2021. But to quote Nicolai Tangen, is this as good as it gets for now, at least for the Fed? Over in Japan, it is quiet, at least for the moment, hovering around that 159 level on the dollar versus the yen. At what point do we get more action potentially from the Bank of Japan or from the Takaichi regime over there? And Brent crude fluctuating this morning, $89.04 on Brent. Under surveillance this morning, gearing up for November.
I have been telling you that this campaign was about the many versus the money. Well, guess what? The many just won. We are going to fight the corruption, whether it's in the White House or in the halls of Congress, because the grift has to stop.
Here's the latest U.S. primary election results shedding light on what's to come in November. Progressive Democrat Peggy Flanagan soaring to victory in the Minnesota State Senate primary, while moderate David Crowley is projected to win Wisconsin's gubernatorial primary in an upset over Democratic Socialist Francesca Hong. Bloomberg's Tyler Kendall joins us now for more. Tyler, can you give us a sense of what we've learned over the past 24 hours heading into November?
Well, Lisa, one of the things that last night's results tell us is that the intra-party fighting for Democrats is far from over. These, of course, were two separate races, but Francesca Hong's loss in Wisconsin does mark a halting in the momentum for Democratic Socialists after a string of victories in recent weeks. But we have to keep in mind Hong failed to secure the endorsement of some prominent progressive figures in the party, like Senator Bernie Sanders, amid reported concerns about her viability as a candidate come the general election. Meanwhile, Lieutenant Governor Peggy Flanagan in Minnesota did secure those key endorsements, and there's now big implications on how both parties take last night and translate it into messaging ahead of the midterms. Flanagan, for her part, says that she will focus on the economy as Republicans face headwinds of their own. President Trump has a pretty significant and solid track record when it comes to endorsements, but we saw his preferred candidate in the Republican primary for the gubernatorial race in Minnesota lose his bid. And then, Lisa, of course, last night we were closely watching that South Carolina primary for the seat held by the late Senator Lindsey Graham. His sister, Senator Darlene Graham, advanced to a runoff, but she failed to secure the majority of a vote. And she, of course, is endorsed by President Trump. So there's going to be questions about his endorsement power there, because she's set to face Republican Congressman Ralph Norman, who has a much more complicated relationship with this White House.
Well, Tyler, just to build on that, what are we learning from that, particularly heading into November? Is every single one of these local elections really bespoke, or is there a larger message about incumbency and the establishment in both political parties?
Well, it depends which side of the aisle we're talking about, because, Lisa, last night we saw an incumbent Democratic House member in Connecticut lose his bid at re-election, marking the 7th Democrat so far to fail to advance beyond the primary stage, despite defending a seat that they have held for, at this point, years. So there are questions here about this idea that Democrats want to see some new energy in the party, some new ideas in the party. On the Republican side, it's a little bit different, including when it comes, of course, to this key seat in South Carolina. It's interesting because we're expecting this seat to play into Republican hands. This is a solidly red state. But when you have President Trump diving into the race supporting Senator Darlene Graham, it does raise questions about the president's power when it comes to his base, considering Ralph Norman is one that's actually clashed with the White House on a few different occasions, including when it comes to some of the president's signature policies and the idea of being perhaps one of those more fiscal hawks on Capitol Hill. There is so much to watch here as we get closer to the midterms, but both parties are really zeroing in on the economy as it continues to remain that top issue for voters. Lisa's, very quickly, I'm sure you saw last night the reporting that NEC Director Kevin Hassett, as well as in a conversation with Larry Kudlow, had floated this idea that we could see some more tax proposals from the administration as we get closer to the midterms and they try to hone their strategy to get voters back on their side.
Tyler Kendall, thank you so much for that. Jessica Taylor of the Cook Political Report joins us now to build on the conversation. Jessica, just want to start with, what's your takeaway from the past 24 hours in the local elections, the primaries that have come through?
I think it's that candidates and campaigns matter. You saw in Wisconsin that Francesca Hong really ran a shoestring campaign and didn't even run ads in the general election. And this really mattered. I think that the electability argument did ring true when she was going on there and doing so much media, when she was talking about potentially canceling Thanksgiving. There was just a raft of opposition research that Republicans were going to use against her. And I think it shows us that issues still matter too. In Minnesota, you had the ICE raids there earlier this year and the killing of 2 citizens that really resonated in that race, especially in a state that was really savaged by Metro Surge. And so you had Angie Craig that had voted for the Lake and Riley Act. Peggy Flanagan really attacked her heavily for that. And so while this was a more traditional progressive versus centrist fight, I think it had a lot to do with issues that were also very germane to the state.
So for the Democratic Socialists, is this just a hiccup or is this a real pivot going into the general?
I think that Francesca Hong was a unique candidate and unique in not great ways. As your reporter mentioned, Bernie Sanders, Alexandria Ocasio-Cortez did not endorse her. She did not have the candidate skills that we saw of an Abdul Sayed last week, and it should be clear that Abdul Sayed does not identify as a member of the Democratic Socialists of America, while Francesca Hong does. But of course, they're all progressives and will be painted with that broader brush. But it really, I think it comes down to the fact that Crowley, this was a really topsy-turvy gubernatorial primary. You had the more moderate frontrunner, the lieutenant governor, that had to get out of the race for campaign mismanagement. The sitting governor, Tony Evers, appealed to David Crowley to get back in the race. At this time a month ago, he wasn't even in the contest. And then you had Mandela Barnes, the former lieutenant governor, that dropped out just a couple of weeks ago. So this made this race really hard to poll. So again, I think there were some really localized issues, really kind of that made this race hard to gauge. But I think it really speaks to, I do think the electability argument in a state like Wisconsin, that is the quintessential swing state that is so critical to Democratic hopes in 2028, did break through. But I think that Hong hurt herself by going on such a media tour and really saying things that felt outside of the mainstream, I think, even for progressives.
I'm glad you brought up polling. Going into this race specifically, Marquette University had hung up 25 points. State Navigate had hung up 29 points. Public Policy plus 20. Why was the polling so off?
Those were a little bit, this race was moving so fast. As I mentioned, you had at the end of the month in July, Mandela Barnes got out, so their polling still included Barnes. Crowley had just gotten in at the middle of July again. I think it was just hard to sort of measure that late surge. And I do think some of the polling, particularly in primaries, oversamples because of the way that it's reaching younger voters. It oversamples younger voters, and I think undersamples older voters, particularly voters of color. And those were voters that both Haley Stevens last week in Michigan did better with, and that David Crowley did better with in Wisconsin as well.
Taking a step back, what does all of this say to you for the midterms in November?
Well, Democrats are much better off with a candidate like Crowley atop the ticket. They want to take back the state assembly and the state senate in Wisconsin, and they have some key House congressional races that they're also trying to flip. Minnesota doesn't, it's a competitive state, but not as much so as it's not a state that Democrats, it factors into the majority control of the Senate. So I think it just matters. What it says to me last night is that candidates and campaigns matter. You saw Flanagan run a really aggressive grassroots campaign, and both candidates were on TV with advertising. Hong, she didn't run a traditional campaign. She didn't have consultants. She didn't have polling. She didn't run television ads. I think that in a state like Wisconsin, you have to have just the building blocks of campaigns. So it's not vibes that you should go with. It's, I think, candidate infrastructure and campaign infrastructure matters.
Jessica Taylor of the Cook Political Report, thank you so much for spending the time this morning. And one thing that Tyler was flicking at earlier was this capital gains tax and removing it as one of the proposals from the President Trump camp. What did you make of that in terms of who they're trying to cater to? Because that isn't necessarily popular among the traditional Trump base.
No, and I'm not actually sure that's going to be able to get through Congress ahead of a midterm election, when you can see, and these candidates we saw last night, but you could see this even with individuals that are up for re-election, they want to focus on everyday kitchen table issues, higher gas prices, higher grocery prices. This is all what is going to be the biggest driver, as well as AI and data centers, into the midterm elections.
Yeah, which is the reason why we keep watching oil prices and what's going on at the pump. Coming up in the next segment, Amanda Lynam of Goldman Sachs as NVIDIA eases AI debt concerns, at least for now. Plus, Vonnie Quinn with your morning movers, CoreWeave and Supermicro results giving the tech trade a boost. This is Bloomberg Surveillance. A bit of optimism after 2 days of declines in equities. Right now, you're seeing a lift pretty much across the board, led by big tech after last night's earnings from CoreWeave and Supermicro. More on that from Vonnie in just a minute. Up 0.25% for S&P futures. Nothing on the crude front, which maybe is giving some people some relief. The idea that you're not seeing much action, $88.92 on Brent. Yields lower. This is notable. Watch this space. Are people finally seeing value in real yields, particularly at the long end ahead of a slew of auctions? Led today by the 10-year note. 10-year notes right now currently yields 4.66%, 2 hours away from the cash open. With tech very much in focus, here are your morning movers with Vonnie Quinn. Vonnie.
Yes, Lisa, another quarter of record revenue for CoreWeave. And while the last 4 times that happened, the market sold the stock off, this time it's rewarding CoreWeave, right? So we're up almost 20%. It is a volatile stock, and it has been on a little bit of an upswing after a couple of months of a downturn. But certainly, Customers and investors much cheered by the fact that it's also broadening out its customer base and that the AI build-out continues apace. That's the same story for Supermicro, which seems to have put all of its accounting problems behind it at this point. It's also broadening out its consumer base and is very, very well positioned to deliver NVIDIA servers to its customers, which puts it in a better position than some of its peers. Again, that stock is higher in the pre-market. Let's move to some other types of companies that are also seeing gains in what could be a very cheery market today, at least until we get the CPI data. H&R Block up more than 12%. It hit a bottom back in February when we had all of those software stocks sell off. Well, it's been on the rise pretty much ever since. And this quarter, it delivered a beat and a raise. It also raised its dividend by 9.5% to 46 cents a share. Experimenting, its international and domestic and DIY revenue beat expectations. And then for a little dessert, let's look at Cava, which is also really reaping the benefits of a beat quarter. So Cava really just keying in on the protein obsession. Apparently there was an inordinate amount of pomegranate glazed salmon sold this quarter, which does sound particularly tasty, I must say, but also consumers adding on. So we heard that from Starbucks as well. The add-ons really add up. In Cava's case, particularly sumac flavored pita chips. Lisa.
Thank you so much, Bonnie. And pomegranate salmon is something that Annmarie has on a regular basis.
Yeah, I'm kind of, Bonnie made me hungry, but I also wonder, is Cava gaining? Because a lot of people are deciding we're not going to go to Sweetgreen because of what is going on.
That's true. They cook their food, so it's not necessarily the
exactly.
raw
Maybe
lettuce.
It's a little safer for this quarter for all the finance bros in Midtown Manhattan.
Maybe that could be the case, or it could just be trendier because it's sort of a phase, right? Whether it's south of the border or east of the border, which one is the sort of popular cuisine? On our radar this morning, less of that, more of this. Shares of CoreWeave soaring in pre-market trading. The company reporting faster than expected sales growth and inking more than $25 billion in new customer orders as AI spending continues to grow. Vonnie was just talking about that with those shares surging this morning. President Donald Trump doubling down on the Strait of Hormuz.
We have total control over the Hormuz Strait right now. They don't have control. We have total control. We own it. And at some point, maybe they'll do something and then they get blown away.
The U.S. and Iran hardening their stances as negotiations remain deadlocked over the waterway. And finally, President Trump weighing a cut to capital gains taxes and an exemption for certain home sales.
He wants to hit people with the things that are promises that we're going to do if the Republicans have power in the future. And so you can expect a lot more policy between now and the midterm.
Most tax changes require congressional legislation, as Annmarie was just mentioning, making it unlikely before the November midterm elections. At the same time, I think the takeaway from this is sort of interesting in terms of who are the constituents that President Trump is targeting, considering that capital gains taxes and eliminating some of them would be more likely to help the upper end of the K.
Right, the top of the K. And really, when it comes to midterm elections and potentially where the president is not polling well is on kitchen table issues in terms of where the economy is. You see that in terms of gas prices and grocery prices. So potentially going to have to tweak exactly where they mention these policy proposals, because these are just going to be proposals. This is not going to actually be able to tangibly happen before the midterm election. And if the Democrats have a good night in November, then I don't see this happening, and for years.
Yeah, but I wonder if it's drawing a distinction between some of the socialist policies and saying, no, we believe in capitalism, regardless of some of the criticism that people have been talking about with respect to taking stakes in companies, deciding which ones, et cetera. You can make a lot of arguments, but nonetheless trying to draw that distinction.
And potentially the home price one might resonate with individuals. They suggested exemption for sales of homes worth $2 million or less from capital gains tax. You have Kevin Hassett saying the boss is very interested in this. Housing has been a priority for this administration. And I remember during the president's State of the Union speech earlier this year, potentially he was going to say that the United States was in a housing emergency, a housing crisis. This is why he is so obsessed with where interest rates are, because he wants to see mortgage rates come down.
Yeah, and mortgage rates might not be facilitating sales of houses. We are seeing lots of sales of other things, including chips and all things related to tech. Speaking of tech, NVIDIA easing Wall Street concerns after clarifying its limited exposure in its $500 billion plan to finance the next wave of AI infrastructure. The plan is the latest among tech giants tapping the debt markets for its AI ambitions. Amanda Lynam of Goldman Sachs writing, we see scope for private markets to play a larger role in financing the AI build-out as the multi-year issuance cycle extends. That said, this will likely come at a higher cost of capital. Amanda joins us now for more. Amanda, great to see you. Thank you for being here.
Thank you for having me.
So we've already seen this in terms of the higher cost of capital with spreads on AI-related debt expanding more than elsewhere. How far could it go? I mean, in other words, as someone who's a buyer of this, how much more money do you want?
Right. So I think, good morning again. So I think it's important to note at the start that we're not really concerned about access to capital for this theme across a range of markets and structures. There's a fair amount of capital that I think is very excited about putting money to work here. But what we do expect is that as this multi-year issuance cycle extends, there will be more nuanced conversations from investors about where to take this exposure and at what price. One of the key kind of misconceptions that I hear from cross-asset investors is an understanding or an expectation that the U.S. IG bond market will do almost the entirety of the heavy lifting here. And for a variety of reasons, we don't expect that to be the case. You've already noted the spread widening that we've seen in the typical traditional credit markets. We think that can extend more broadly when we're referring to a higher cost of capital from private markets. It's really driven by their recognition that they provide certainty of financing and execution, and they get paid for it. So we see that in private credit. There's a difference between private credit and where a loan would price in the syndicated market. We're expecting the same with the AI build-out, but importantly, the access to capital is there. It will just be more nuanced as this issuance cycle extends.
And in some ways, the NVIDIA agreement kind of solidified this exact point, that the capital is there. To have a memorandum of understanding tied to $500 billion of financing going forward is a way of saying we have the ability to tap this if we need it. I just wonder about the acceleration of the amounts needed in every single year. It seems to be accelerating this year and accelerating next year. It seems to always be more and more and more. When is it peak requests for financing? When do we see the end of this build-out cycle?
Sure. So without commenting on any one transaction, I think really our view on this is that given the delay between investment and monetization, we're expecting 2027 to be the peak year of the highest level of capex that will be debt financed. These companies have guided towards a delay of anywhere from 3 months to 2 years between when they invest and when they start to monetize. Of course, it's possible that it could be quicker than that, but that is our base case, is that 2027 will really be the year where the largest share of capex, we estimate 35%, will be debt financed. So that implies $400 billion in our view of direct issuance from the hyperscalers. We're expecting $300 billion additional of project finance issuance outside of that. And then it's important to keep in mind, it's not just the hyperscalers, it's the broader AI ecosystem that is looking for capital. So 2027, we expect to be an active year across markets and structures and currencies for the AI build out. And then the private markets, as this multi-year cycle goes on, will likely play a bigger role there.
You mentioned in your note $4.5 trillion in dry powder. Is that going to AI directly? Is it going to the infrastructure you just mentioned surrounded it? Or just is that basically earmarked for other items?
Right. So what is most interesting that we've noticed is that historically we were expecting infrastructure and real estate to play the largest role in financing the digital infrastructure build out. What we've seen is a bit of a blurring of the lines across private markets. There have been some financings that were classified as venture debt. We've seen private equity play a role. So that $4.5 trillion figure that you noted, that's total dry powder across global private markets. So private equity, credit, infrastructure, real estate. But we're less focused on the amount of dry powder within each silo, because really what matters to a bondholder is how much dry powder is available for lending capacity across the private ecosystem. Because again, all of these categories have been participating. So that's what we're most focused on. It won't be the entirety, but just reading what alternative asset managers and a wide variety of financial market participants have commented on, they're all very excited to take exposure to this theme. So I wouldn't expect the entirety to be dedicated to AI, but that's what gives us confidence that the capital is there. I would say the other point to raise is that our conversations with market participants are really bracing for capex revisions higher in 2027. That's something that I hear a lot from clients, is almost baking in an expectation that these numbers could move higher. And so I do expect the capital markets will be a key role in financing this build out, and we see a larger role for debt markets in particular.
Is there still as much demand for long-term debt, for 30-year, 40-year, 100-year tech-related debt, which is beneficial for them to lock in financing for that long, but potentially becoming more of a constraint on the investor side.
We are seeing a bifurcation between AI-related issuance and kind of everything else. To your point on longer end debt, we are seeing steeper curves, which suggest a bit of wider spreads at the long end. The reason for that is somewhat mechanical. When these companies are issuing such large bond deals, they have to be spread across the curve. In general, there's still a fair amount of demand for long-end credit, but it's been episodic. It's fluctuated with the rate backdrop. We actually posted a piece a couple of weeks ago on this, which we kind of outlined the demand backdrop across credit broadly. It's pretty solid. Foreign demand and fund flows, kind of trading activity across the street. And so the support mechanism is there. It's part of the reason why index level spreads have been holding in so well, because while tech has been widening, everything else has been kind of holding in more than you would expect.
Is there a threshold for yields at which point it curtails issuance?
I think that bar is very high. I think the binding constraint in our view is index issuer concentration constraints and market capacity constraints, as opposed to a higher cost of capital deterring capex spending.
So in other words, yields could go a lot higher and still the total volume will continue.
We are positioning for wider spreads, yeah.
Thank you so much. Amanda Lynam, always great to catch up with you. Amanda Lynam of Goldman Sachs here in New York. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg brief with Vonnie Quinn. Vonnie.
Lisa, Senator Darlene Graham advancing to a runoff election to replace her late brother as the Republican nominee for Senate in South Carolina. With 33% of the vote, Graham will face Representative Ralph Norman, who had 25%. It'll be an August 25th runoff. The winner will face off against Democrat Annie Andrews. Boston Fed President Susan Collins says businesses and households in the Northeast are being squeezed by inflation. In an interview with the Financial Times, Collins saying the Iran war is squeezing lower-income Americans. Collins adding inflation risks are greater than mixed labor data. Shein is planning to take investor orders for its Hong Kong IPO as soon as next week. The South China Morning Post citing anonymous sources saying the fast fashion retailer may seek a valuation of $35 billion. The report also saying the company aims to complete the process by the end of August. And that is your Bloomberg brief. Lisa.
Thank you so much, Vonnie. Up next, bracing for the inflation impact.
This week's inflation number is going to be very important.
The results of the CPI and PPI numbers will be whether or not the Fed will make a move, before the end of the year.
September sitting at roughly 50-50.
Former Philly Fed President Patrick Harker joins next. This is Bloomberg Surveillance. Good morning. The wall of worry continues to be climbed as a result of earnings, which are exceeding all expectations, coming in at some of the fastest pace that we've seen going back to 2021, particularly in the tech space last night, which is a reason why the NASDAQ futures leading the charge up almost 0.7% this morning. S&P futures up a little more than 0.25%. Similar move on the Russell 2000, also coming with a bid into bonds, a sort of nirvana that people have been looking for. Everything rally continues, particularly at the long end of the yield curve. Yes, you're seeing a 2 basis point move at the front end of the yield curve, 4.19%. But even that bid into the 10-year, look at that, 4.6578%, if you're going to extend it out to the fourth decimal place, ahead of a $42 billion auction at 1 p.m. Eastern. A question about whether this could all change come 8:30 a.m. Eastern. Given the CPI print that's coming out, will it be enough if it comes in, AMH, at the lowest level going back to March of 2021?
Well, that is why the bar is pretty high for the CPI report today. And as you've been mentioning, it really is literally a coin flip for whether or not the Federal Reserve hikes interest rates according to the market in September. But we have to remember, we have a lot of other prints to come out as well. Plus, I was just seeing a Bloomberg opinion columnist on Twitter say, feels like everyone's just waiting for Jackson Hole. How much will we learn as well when we finally get a speech from Kevin Warsh after the press conference that some people felt was a bit fumbled?
Yeah, there's an issue about CPI and the actual data, and then the reaction function from the Federal Reserve to said data. Under surveillance this morning, bracing for inflation impact.
This week's inflation number is going to be very important, more important than what we saw on Friday's payroll.
The results of the CPI and PPI numbers will be just more, trying to tilt the balance towards whether or not the Fed will make a move, before the end of the year.
September sitting at roughly 50-50.
Here's the latest. Boston Fed President Susan Collins adding to the debate over a possible interest rate hike as soon as September, telling the Financial Times inflation is too high ahead of today's CPI report due out in less than an hour. Former Philly Fed President Patrick Harker writing, watch core, not headline. Core, and specifically shelter, is what decides September. Patrick joins us now for more. Patrick, great to see you. Really appreciate you taking the time. How much is core going to really make a difference if it still is above 2%, given the fact that we're hearing a degree of impatience about it being more than year 5 that we've been above the Fed's target?
That's right. So thanks for having me. If core is above 2, significantly above 2, I think you're going to see the Fed raise. Now, I think they have to at this point. As you said, we've been above target for over 5 years. So the Fed has an issue of credibility. They have to act. They can't just talk about being tough on inflation. They actually have to do something about it.
At this point, though, Patrick, some people would argue that we're seeing inflation come in, particularly when it comes to shelter, that the expectation is for core to be at the lowest level at 2.4%, potentially going back to March of 2021. Is that enough?
I don't know. I mean, the committee is very split, as you said. And we're seeing a lot of people, not only the dissenters, the people who are voting, but the non-dissenters speaking out. So they are clearly signaling that some increase, whether it's this meeting or next meeting, is in the cards.
You said that the Fed has a credibility problem at this point. Would that be true regardless of whether the Fed chair was Kevin Warsh or if it was still Jerome Powell?
Yeah, I think if you just miss your target, you don't do your job for 5 years, people start to question whether you can do it at all. So I do think the Fed's going to have to do something to prove that it really is serious about inflation.
It just feels odd because now we are actually see inflation get softer. Where was the Fed in the last 5 years? Do you not think they acted appropriately?
No, I think that we were looking, I was there, right? So, yes, we waited too long to start raising rates after the pandemic. I think that was clear. And we were early in Philadelphia wanting to raise rates. But given that, and given all the supply shocks we've seen, the Fed has been in this holding pattern. But these supply shocks, you think the textbook says look through them, right? But they keep coming, and they're strategic. They're not just acts of nature, acts of God. We have to really look at these now as something that is more sustained. And I hate to bring up the transient word, but these supply shocks aren't so transient, and particularly with respect to Iran.
So you think there's a potential that higher oil prices, it's bleeding through the supply chain, and those prices are becoming entrenched?
Yeah, I do. Because do you see an end to this war? I don't. I hope to God that we have an end to this war, but I don't see it. So this is going to continue. The on-again, off-again opening of the strait will just continue to create this uncertainty in the markets, particularly in the energy markets.
But as a former Fed official, is it the Fed's job to start pricing in potentially when a war may end?
No, its job is to get inflation under control. And because of the war and other circumstances, I mean, remember tariffs. Tariffs are still working their way through the economy, and now we look like we're having a new round of tariffs. So those are also inflationary. Those also are supply shocks. But we keep getting supply shock after supply shock. It's hard to keep looking through those. You have to act.
Patrick, are you on one of the task forces that are going to be potentially releasing some results? No? I am curious, though, do you think that it's appropriate to start looking at the way that we evaluate inflation and to potentially look for an overhaul 2.0 about exactly how the Fed is conducted?
You know, there's lots of ways of looking at inflation. The academic community and the business community have developed all kinds of metrics. And your job as a policymaker is to look at all those, not one single number. So the idea, the hope that somehow we're going to do this work and we're going to come up with the magic index, I just don't believe. We'll never have that.
One thing that I know you were really out front about with respect to inflation was sort of a vibe. It's not a vibe issue, but with respect to anecdotes and how important that was in factoring into your calls when you were the head of the Philadelphia Federal Reserve. What's your sense as you go around and you talk to people, and I understand you're no longer at the Philadelphia Fed, do you have a sense that people still are preeminently concerned about inflation, that the economy is an incredibly solid otherwise position?
Yeah, they're clearly worried about inflation. That's still on their list. But also the softening of the labor market is on their list. They're concerned about particularly the bottom of the K in the K-shaped economy, that you're seeing credit card defaults going up. You're seeing all kinds of softness in the consumer side. So it's all of those things they're worried about as well.
Isn't this a key debate at the Fed right now? If they hike interest rates, it's only going to hurt the lower K.
But what's causing the softness in the labor market? It's not just the interest-sensitive sectors. In fact, if you look, manufacturing's been adding. It's not. There are other issues. Some of those are related to immigration policy, tariff policy, and so on. Mark Zombie from Moody's has a great piece out right now looking at native versus non-native workers in the economy. And the story is pretty simple, right? If you lose those immigrant workers, then non-native workers also lose their jobs. And so these are policies that the Fed cannot control, immigration policy, but they deeply affect the labor market.
How will raising interest rates 2-3 times reduce inflation given this backdrop?
Well, what's driving a lot of the inflation right now, not all of it, clearly energy can't do a whole lot. But I know your previous speaker, your guest, was talking about AI and the AI build out. That's clearly having some inflationary effect. We don't know exactly how much, but look, they're buying lots of stuff. They're buying all kinds of things. They're looking for contractors, plumbers, electricians. So that's bidding up prices. If that slowed down a little bit, it would help the inflation story.
Former Philly Fed President Patrick Harker, thank you so much for being with us this morning ahead of this CPI print at a time where we've been talking about how a Fed rate hike is essentially a coin flip right now. Interesting to see how AI is such a pivotal part of the conversation about what's driving AI, what's driving inflation, and potentially what a rate hike could do.
Because that's why between oil and AI, you're seeing inflation on both the supply and demand side of this story. But the issue is, if you were to hike rates, are the hyperscalers going to stop spending? Potentially not. So then who do you hurt? And I think this is why this is a huge conversation right now at the Federal Reserve and why they are so split.
It's a huge conversation here on Bloomberg Surveillance, which we'll keep having ahead of that CPI print. Coming up in the next hour, Alex Altmann of Barclays, Jim Bianco of Bianco Research, Tiffany Wilding of Pimco, and David Kelly of JPMorgan Asset Management. You're watching Bloomberg Surveillance.
All of our macroeconomic signals are very bullish on the U.S. economy.
Inflation expectations are very benign.
As long as we get these benign readings, that does still give the Fed some breathing room.
The data may not support an immediate rate hike in September.
September sitting at roughly 50-50.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to the third hour of Bloomberg Surveillance. Stocks ticking higher with good tech earnings and ample financing, assuaging concerns about profligate spending. Oil putting pressure on risk assets with global oil inventories rapidly being depleted this morning. Prices just inching upward, and the clock is ticking less than a half an hour away from U.S. CPI, with inflation becoming the key indicator for Federal Reserve policy.
It's one of the most important data points we're going to get this week and actually this summer ahead of Jackson Hole's speech from Kevin Warsh. And we just heard from Patrick Harker, former Philadelphia Fed president. And he's talking about that we've had shock after shock when it comes to tariffs, what's going on in the Iran conflict. He asked us, when do you think that you're going to see an end to this war? So that is why he thinks it's becoming entrenched when it comes to inflationary pressures. And he thinks the Fed is going to be forced to act also to shore up their credibility.
Yeah, well, this is why a lot of people are viewing this as a coin flip right now, a 50% chance that the Fed is going to hike rates or stay on hold. We don't understand the reaction function, though, and that's really the key question. The expectation is for inflation to come in, core CPI to come in at 2.4%, according to Bloomberg Economics, which would be the lowest going back to March of 2021. Yet we don't understand exactly what that will mean going forward for the Federal Reserve because we don't understand how much consensus there is on this committee.
Which is why Jackson Hole is becoming ever so important. At the same time, according to people close to the matter, told the Financial Times last week that when it comes to Kevin Warsh and how he's viewing everything, if we were to see hot CPI, potentially that would warrant a hike. But to your point, if it comes in and it's still on a downtrend when it comes to inflationary pressures, then potentially the Fed could just look through this once again.
Ultimately, everything is an AI trade, whether you're on the Federal Reserve and you're looking at inflation or whether you're looking at markets. And right now, you're seeing the optimism coming from the CoreWeave and Supermicro optimism from earnings last night, the sense that earnings keep beating expectations with pipelines building, giving some feeling of momentum, even with ongoing skepticism about the financing, et cetera. Right now, it seems to continue to surprise to the upside.
Right. So this week, NVIDIA came out and said, you're worried about financing? Well, I have a bunch of rich individuals and their companies backing this with a pool of money. And then you have Supermicro and CoreWeave, which are also bellwethers ahead of NVIDIA's earnings report at the end of the month. And both are showing that this build out when it comes to AI is incredibly robust.
And today you're seeing tech lead the way once again in futures, with NASDAQ futures up now almost 0.8%. S&P futures up nearly 1/3%. You're also seeing a bid into the bond space, 2s, 10s, and 30s ahead of that CPI print. Interesting to see the outperformance coming from the 10-year space ahead of the auction later today. 2-year yields 4.19%. 10-year yields down 3 basis points at 4.66%. That $42 billion auction of 10-year notes at 1 p.m. 30-year notes still the sort of loser in all of the sell-off over the past couple of weeks. Today getting a little bit of a bid, 5.21%. And then, of course, what you see in oil is that churn, a question of what a quagmire looks like in the crude space. It means there still are a lot of questions hovering at these elevated levels, $89.12 on Brent. Coming up this hour, Alex Altmann of Barclays with stocks looking to snap a 2-day slide. Jim Bianco of Bianco Research on why he's all for the Fed getting rid of forward guidance, and Tiffany Wilding of Pimco breaking down inflation data. We begin this hour with stocks inching higher again ahead of the latest read on inflation. Alex Altmann of Barclays writing, everyone expects a quiet August post-CPI. Everyone? Somehow, I don't think it will be that easy. The market may still be vulnerable to rotational shocks. Alex joins us now for more. Alex, do people really expect this to be quiet? Because so far, this summer has been anything but.
Well, I would use the word hope. Good morning, by the way. I think people are hoping that they get a little bit of respite. What has been a pretty frenetic summer. And obviously, we've had this massive rotational shock that happened whilst I was away, so that was annoying. But the point being is that, we had this enormous drawdown in momentum over the course of July, something that we had sort of been advocating for and warning about for several weeks, really as early as May. And now that it's transpired, basically all of our data would suggest that, yes, we've had a little bit of froth coming out, a little bit of leverage coming out of the system, but at the end of, we're still vulnerable to shocks, and we're still vulnerable, I think, to those rotational shocks, especially within momentum, and obviously that's tied very much to the AI trade.
I'm just crying for you that you are in somewhere that gave you this lovely tan instead of experiencing the rotation that we all lived through. I am curious, though, do you think that the leverage has built back up, that there still is this sense not of overvaluation, but exuberance in certain pockets of the tech trade that have been brought back to the market after the sell-off and then bounce back post-situational awareness?
So we know that the re-risking did happen pretty violently last week. And in the context of, we're talking about relatively small changes. Holistically, it's not like suddenly the whole world has suddenly turned mega bearish on AI. And I think one area to sort of focus on in terms of just measuring that yardstick of re-risking rather than thinking about net leverage within the hedge fund space, which has gone back up, is obviously the levered ETF space as well. And a lot of people use that as a barometer for how much leverage is moving in and out of the system. And if you actually look at the shares outstanding rather than the actual AUM, which is vulnerable to price changes, the shares outstanding has still gone up. So it's not like you've suddenly taken a huge amount of leverage out, quite the opposite. Korea, however, has seen a huge amount of deleveraging. So I would say a bit of a bifurcation into the core-centric AI theme. I think there's still a lot of exuberance there.
And you think the market is still vulnerable for rotational shocks?
I do, yes. And so,
but what will be the catalyst for that? Because we've seen non-stop catalysts for this market, and somehow it continues to bounce back.
Well, so I think you need to sort of slightly delineate what's happening with the market and what's happening below the surface. So we've obviously seen a massive momentum unwind, and during that same period, you actually saw a significant bid to quality. And I really want to focus on quality as a factor for a second, as a stylistic rotation, because if you recall, in 2025, high-quality stocks got beaten to death. It was the third largest drawdown that we saw in that factor since over the past 20 years. And so it was around about May of this year that we began to sort of observe that quality was looking extremely cheap. And just to illustrate this point, quality and value as two sort of stylistics should be quite separate to one another. It's rare that you get to buy quality stocks at a low valuation. Right now, we're seeing the highest correlation between those two factors basically ever. And if you actually look at a backtest of that, it's telling you want to be buying quality stocks. And that's exactly what we've seen. So we've seen quality as the best performing factor since May, at the expense mostly of momentum and residual volatility and all these other things. So you can see a continuation of that. This is a medium-term trade. This is not something which you're just going into and out of over the couple of weeks.
If you think quality is now the rotation trade, how long is it going to stick?
I think it's going to stick for a while. If you think about it, the peak of fiscal tailwind is behind us. We've got a question mark around what's happening with interest rates. We've got a question mark around what the future of the employment is going to look like. We've got a question mark around credibility. In this kind of environment, this should be the perfect setup for investors to go to higher quality businesses, especially because you'll be able to get them at a valuation discount now. So I think this is a theme that's going to run basically for the rest of the year, and we're only really in the first innings of it.
Where does CPI come in, given what this means for the Federal Reserve and the potential for some sort of carry-on with respect to yields?
Sorry, so the question is...
CPI, where does CPI factor in?
I think the CPI at the end of the day is one of many factors. I don't think it is exclusively the factor. But, I mean, at the end of the day, we polled a bunch of guys going into this report. I don't think anyone really had a particularly strong view on where it's going to shake out. If it's low, then you've got a bunch of Wall Street that's telling you you're basically going to have the Fed on a pause well into next year. And you've got other sell-side firms that are calling for 3 hikes still this year. Basically every meeting between now and the end of 2026. So I think at the end of the day, this isn't just about CPI. I think there's a lot of other factors that go into this, whether it's the trajectory of growth, whether it's AI financing, so many things that are really sort of playing a role.
And I think that's the reason why I'm kind of struggling as I look at CPI, because the direct read-through for markets is what it means for yields, right? And there's a question about if the Fed were to hike rates, would that be a positive? Would it might potentially even create a bid to the long end of the yield curve and create sort of a tailwind for equities, versus if they remain on hold and there's inflation and you see that long end of the yield curve continue to widen? Could that potentially be one of those disruptors in markets that you potentially are looking for?
It could be, but then at the same time, what are other factors determining the long end of the yields? What's happening in Japan is clearly a factor, but also AI financing, the crowding out. I mean, these guys are issuing hundreds of billions of dollars of debt, and a lot of it's getting termed out to the long end of the curve. So that is creating like almost a competition for capital. And we wrote about this. We've never seen an environment really in history, going back for the past 30, 40 years, of modern capital markets, where we've had high interest rates and this amount of issuance across the capital stack, so across equities, IG, and obviously the government needs to go cap in hand as well. So between all three of them, this crowding out effect is contributing collectively to where yields are going.
Do you think it's better for companies to be issuing equity or debt right now?
That's a loaded question because we wrote exactly on this. So the fact that equity risk premium is negative is in itself indicative that companies should at least consider the equity channel. And we are seeing that. We've obviously saw another high-profile sort of at-the-money offering, was it end of last week or beginning of this week? We had obviously Google. There's plenty of reports that other hyperscalers are going to potentially come and actually issue more equity supply come after Labor Day. And that's something which investors have in terms of a bit of an amber light when thinking about markets going into the autumn ahead of midterms. So as far as we're concerned, it actually does make sense to tap the equity channel, especially when you consider not just the negative risk premium for equities, but also the fact that you've actually already issued a lot of IG.
You don't think that's going to be a diluting factor that could potentially pressure valuations?
I think it could be. So the good news is that the hyperscalers obviously delivered some phenomenal earnings. And I think that's enough to probably allow them to carry and issue near term without any sort of significant effect from an investor base. However, it's not universal. We know if you're the first to go, you generally get rewarded. But then if you have a series of companies after that, I think it becomes more problematic. Not to mention, we obviously still have a very large IPO that's coming ahead of the midterms as well.
I hear that that's on tap, and they're trying to make themselves look pretty ahead of that. Alex Altmann, thank you so much for being with us today. Alex Altmann of Barclays joining us here in New York. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Bonnie Quinn. Bonnie.
Lisa, thank you. President Donald Trump says the U.S. has total control over the Strait of Hormuz and that Iran would get blown away if they took action. Trump's comments coming after Pakistan's defense minister told reporters in Islamabad that the two sides were close to some sort of arrangement over Hormuz. A federal judge blocking key parts of President Donald Trump's mail-in voting overhaul nationwide, ruling that the executive branch has no authority to regulate elections. The ruling prevents the administration from changing ballot mail rules less than 90 days before the November 3rd midterms. The Knicks will have some special company as they raise their championship banner on the NBA's opening night. They'll be hosting LeBron James and the new-look Philadelphia 76ers as part of the league's three-game slate to tip off the season on October 20th. And that is your Bloomberg Brief. Lisa.
Thank you so much, Bonnie. Up next, the morning calls, plus Jim Bianco of Bianco Research saying Fed Chair Kevin Warsh has taken too much flack. That's coming up next. This is Bloomberg Surveillance.
I think the market's going higher, and I think it's going higher on earnings. You basically have 25% increase in earnings in the second quarter and about the same in the third and fourth quarters. So, yeah, I've been bullish on earnings, but not bullish enough. It's all these analysts who talk to companies, and the companies are bullish.
That was Yardeni of Yardeni Research with an 8,400 price target on the S&P 500 for the year end. And this is the head of all the calls out there from Wall Street firms with optimism abounding. And frankly, no one can really poke holes in it right now because even though there are these sort of switches back and forth, as Alex Altmann was just talking about, the bottom line is the earnings are coming in at the fastest pace going back to 2021.
And that's where Ed said he's taking his cue, seeing from the analysts and these executives that are coming out and talking about how good the environment is right now. And it's not FOMO anymore. It's all about earnings momentum. And that is what is guiding his light. And he almost leaning into the fact it doesn't feel like he's bullish enough when you look at what analysts and executives are saying.
Right now, markets taking their cue from that kind of tone, seeing an inflection upwards following CoreWeave and Supermicro's earnings, 0.7% gain on NASDAQ futures, S&P futures up 0.3%. In the bond space, a bid led by the long end, interestingly enough, ahead of an auction later today. The two-year yield pinned around that 4.2%. The 10-year yield 4.66%. And in the oil space, fluctuating around, not getting a real read in terms of directionality, still staying above that level that is comfortable, $89.24 on Brent crude, a huge surge over the past week. Time now for the morning calls with two stocks in focus. First up, JPMorgan raising its price target on CoreWeave following the company's upside report on margins. Those shares up more than 18%. Next up, Baird raising its CoreWeave price target, saying the bullish demand environment supports growth. A lot of demand. You're seeing that come through in some of their pipelines. And finally, Citi raising its price target on Supermicro following its stronger than expected earnings and well above consensus sales outlook. Investors counting down to fresh inflation data just ahead. The print set to provide a strong signal on the Fed's path for policy. Jim Bianco of Bianco Research with some words of encouragement for the Fed chair following the backlash that he's received. He writes, the criticism for not providing forward guidance or a reaction function is misplaced. We applaud Chair Warsh for sticking to his guns and getting rid of this practice. Jim joins us now for more. Jim, thank you so much for being with us. I want to start with this idea of forward guidance and reaction function and the distinction between the two. Do you think that there is a distinction between the two, or do you think that people have made too much of this?
Well, there is a distinction, but I do think that they've been conflated together as the same thing. The forward guidance is simply tell us where you're going to go next. And I do think that the Fed should get rid of that. It has caused more problems than it has solved over the years, because whenever the Fed gives forward guidance, it's viewed as a promise And then the Fed's kind of stuck because if the data changes, they either disappoint the market, and we've seen some wild moves because of that, or they follow through on an incorrect policy, think transitory inflation. Reaction function is the rules of the road. And what are you going to do based on if this happens or that happens? Now, the problem with reaction function with this Fed right now is I've been arguing that this is more of 12 independent voters, and it's not really the Fed chairman telling the other 11 how to vote. So we really need 12 reaction functions. And we've already seen that. We've gotten 3 dissents at the last meeting. So we already have 3 different reaction functions from those members. And you could argue last week, Lisa Cook, with her speech in Anchorage, Alaska, is possibly a 4th dissent towards a Fed rate hike. And we wait Chris Waller, who might be another one. And so we're getting a lot of reaction functions all over the place with this Fed, nothing consistent.
We haven't gotten a reaction function, though, from the person at the top of the Federal Reserve, Fed Chair Kevin Warsh. Do you think that's a problem?
I think in long term it is. He should at least give us his reaction function. Now, I sort of understand what he's trying to do. He's got all these task force that are going to look at inflation, and they're going to look at data, and they're going to look at a lot of communications and a lot of other things. So he doesn't want to give us a reaction function and say, yeah, but in 90 days, this might change, or in 4 months, this might change. So I think he's trying to hold out until he gets set with what the committees or the task force come back with, and then maybe hopefully he'll give us his reaction function then. He does owe us at least that.
But through people familiar with the matter, did we not understand a little bit more about how Kevin Warsh is viewing this economy and a little bit of his reaction function through that Financial Times report?
Yeah, we do. I mean, he's a big AI bull, and he does believe that AI will eventually be somewhat deflationary or at a minimum disinflationary over the time period. So you could argue that he is looking at the inflation numbers that we've seen elevated for the last, and I'll go for the last several years. We've had 64 straight months of it being above 2%. And he's thinking that AI might come in and help to push that number down. And now I agree with him, but I don't think that's happening like this year or even maybe next year. But eventually that productivity that you would expect from AI might evolve over a longer period of time than, say, the next 12 to 18 months. But before we get there, I think what you're going to see with AI is it's just going to lead to a lot of squeezes with data center builds and everything else. And it might actually, in the short term, being the next year or so, be somewhat inflationary rather than deflationary.
The fact that AI in the short term is inflationary, do you think that's a reason for the Fed to hike interest rates?
I think that the Fed, let's remember that back to 24, the Fed has cut rates 175 basis points. And if you go back to September of 2024, the 10-year yield is up about 95 basis points since the Fed started cutting. There's been no other experience in the last 50 years where we've had a major long-term cutting cycle and long-term yields have gone up. So I think this, for starters, this is the market signaling that it disagrees with the policy, that long yields have been going higher. So I've been arguing if you want to see a peak in long-term yields, raise the Fed should panic a little bit and raise interest rates. That will calm down the long end of the curve and bring those yields down. All you're doing is reversing some of the cuts. I don't think we could really say that we're going to be pushing off into restrictive territory because of the cuts we've seen over the last 2 years.
Jim, this is a really important point. Some people are arguing the same thing that you are, that if the Fed hikes rate, that actually will ease policy on the long end of the yield curve, which could help the housing market and a whole host of other metrics. That said, it's not coming from higher inflation expectations that the long term of yields are rising. It's actually coming from the term premium. How related is this, or is this really a function of just how much debt is being issued by AI-related players?
Well, I think the debt by AI players is a big part of it. The term premium that we all look at is the kind of the residual leftover that we can't really explain. We could look at inflation expectations. We can look at the forward curve through the short-term interest rates on out, and we could make an approximation of where interest rates are supposed to be. And then we look at where they actually are, and that difference is the term premium that we can't explain. Sometimes the term premium can have embedded into it some of that inflation expectations. Look, I've been arguing that we are in a 3% inflation world, maybe as high as 4%, but not like an 8 or a 10 or a 12% inflation world. So if we're kind of stuck in 3% inflation, and like I said, 64 months being above it, maybe some of that term premium is being confused with inflation expectations, because a lot of the measures we use for inflation expectations, like TIPS securities, don't have a good track record at predicting where inflation is. So it might actually be that. But nevertheless, what the term premium and everything else is telling us is if the Fed wants to run easy policy here, the risk is that the market will continue to go higher in yield, and maybe that inflation fear will continue to percolate under the surface.
We're about a little bit more than 6 minutes away from the CPI print. What are you expecting, and how does that relate to your understanding of inflation? In other words, is this a leading indicator or a lagging indicator of a monthly blip of improvement in the inflation backdrop?
Well, inflation's always been a lagging indicator, but I also would point out that Chairman Warsh in a lot of his speeches has said, we have a dual mandate of inflation and employment, and he said the inflation data matters more right now because he seems to have more confidence in that data than he does with the employment data. He calls it echoes of the past, which is only good on the third revision, which is 18 months later. So this is going to be very important. But I think in this environment with a 50-50 chance that the Fed's going to hike, anything that you would call consensus or a slight beat is going to be enough to keep us into the game of a rate hike coming in September. It would have to be an unmistakable miss with much lower numbers to really start questioning whether or not the Fed would hike in September. And then we'd have to see what the reaction in the long end curve is. Does the bond market, after an initial reaction, say today or tomorrow, start marching higher because the Fed is not going to give that little bit of panic about the higher rates by raising their rates so the bond market could calm down?
Jim Bianco, Bianco Research. Wonderful to get your view. Thank you so much. As we count down to that CPI print, about 5 minutes away, the expectation is the economist surveyed by Bloomberg is that core CPI year over year will increase by 2.5%. CPI headline level year over year, 3.4%.
And this is going to be an incredibly important result, as you've been talking about, this report, when it comes to how does the Fed think about September? Because it is so split evenly in terms of it's split on the board and it's split in the market on whether or not they are going to hike interest rates, the bar has become ever so high as well, considering what happened last week with jobs.
The bar in markets has been lowered a little bit given how short people have been, particularly on long-term treasuries. Potentially some of the action that we're seeing in bonds this morning is people right-sizing that positioning ahead of this print. Coming up, we will break those numbers down. Plus, Tiffany Wilding of Pimco will join us to react. From New York, this is Bloomberg Surveillance. Five seconds away from that key inflation read. Here are the scores heading into that. You see a lift in equity markets pretty much across the board, led by big tech, building as the morning grows. The S&P futures up 0.4%. Yields lower now by 4 basis points. 10-year yields 4.64%. Brent crude a little bit elevated, just up 0.3%, but really key heading into an inflation read that could tip the scales for the Fed. Let's head over to Michael McKee with those numbers.
Well, we're just getting the numbers in, and it looks like we're pretty much spot on. The economist forecasts CPI on a month-over-month basis up 0.1, the core up 0.2, which puts us at 3.4% for year-over-year on the headline, and for the core, 2.5%. Both of those a tick lower than they had been. Let's take a look at some of the categories here that we have seen move. Food up 0.1%. That's down from 0.2 in June. It is also food at home decreasing 0.1%. Energy decreased 1.5% in July after falling 5.7% in June. The gasoline index down 2.9%. So there is the war effect. The Memorandum of Understanding did send gasoline prices down for a while, so the averages worked out. In terms of the core, owner's equivalent rent, 0.3%. Now, that is higher than it has been, and the lodging away from home index down 2.8%. So we're seeing some areas in which there is still inflation. We're going to have to check the super core number, which I'll see if I can pull up here very quickly if it has been updated. Not yet, but I'll get that for you in just a second. That's what the hawks on the Fed are looking at.
Mike, we'll let you take a couple minutes to look at that. Thank you so much. Let's take a look at what's going on in markets in response to this. Not a huge change, although people marginally pricing out some of the rate hike probability for September. You're seeing now 30-year yields continue with the decline. At the front of the yield curve, also withholding some of the shift. You're seeing 2-year yields continue declining as well, but just down now basis points, 4.2%. This, to me, really indicates, yes, nothing has really changed, but to the degree that this would have given a disinflationary surprise that would have caused some sort of flushing out in the short positions, not necessarily the clearing event. If you take a look at what's going on in equities, also seeing the same kind of positivity, not really a game changer considering the fact that this is exactly in line. That said, not necessarily a hot print, giving a little bit more of a rise to the tech wager, 0.9% rise for S&P, for NASDAQ futures. And then when you take a look going forward, the key to me is going to be some of the core PCE factors, given the fact that ultimately it's now kind of a wash when it comes to the overall averages.
This is in line, bang in line. So pretty much what the market was expecting. Maybe some individuals thought we would even see a softer print. Shelter costs, interesting, seeing that headline come through, rose 0.1%, accounting for 2/3 of the overall increase. This is going to be, quite frankly, a very big political issue, but you can see that is one of the biggest drivers when it comes to what is making up the inflation print today.
If you are just joining us, we did get an inflation read bang in line with expectations. Core CPI coming in at 2.5% year over year. If you look at just the headline CPI figure, 3.4%. The monthly is also the same, 0.1% increase for core CPI, and core CPI coming in at 0.2%. Tiffany Wilding joins us now from Pimco. Tiffany, what's your first read on this report?
Yeah, well, I mean, I think you guys hit the nail on the head. This one was just bang in line with expectations. I think 22 basis points month over month, inflation unrounded on the core. I think the threshold that we and other market participants are thinking in terms of what constitutes, quote, too hot on the inflation readings is about 0.2. Of course, this is the CPI, and it'll also be important what the core PCE inflation reading will be later this month. But I think overall, this plus the softer CPI print last month, has to be, a little bit of a relief for Fed officials. Good news for them. At the same time, though, some of the more hawkish members on the committee, we doubt it really changes their minds. So, I don't think this really resolves a lot. I think our lean is still that the Fed remains on hold in September. We'll have some more data releases between now and the meeting that'll also be important, another payroll report as well as another CPI, and we'll just have to keep watching and waiting.
Is any of the disinflation that we're seeing right now coming through this data, just based on the month over month levels, does any of it seem like it has staying power to you based on the components that are driving it?
Well, I think if you look at, the shelter categories, they certainly are, they have a lot of what economists call inertia. They tend to have trending qualities, and it does seem to us like the shelter categories are continuing to disinflate. When we look at market data in the housing market, rents look pretty stagnant, and it'll just take some time for the government data to catch up with that. And I think on the services ex-shelter side, a key piece of some of the acceleration that more recently has been airfares, which adjust to higher energy prices, higher jet fuel prices. I think once again, airfares were a little stronger this month. But as you have energy prices overall that moderate, if they continue to moderate, you should see that also moderate. So, I think overall this is a pretty good report. Suggests to us that, you have inflation, still running above the Fed's target, but good news relative to what we got earlier in the year, which was much higher readings.
It feels like this print also benefited from the fact that we did have that memorandum of understanding when it comes to the conflict in Iran. Tiffany, how vulnerable and sensitive is the August print going to be to what is happening in Iran right now? And we actually saw an increase in oil prices.
Yeah, I mean, so the headline inflation numbers will definitely fluctuate with retail gasoline prices. So we've seen retail gasoline prices certainly come down in June. They came down a little bit more in July. But you're absolutely right. Looking forward, it does look like they could increase a little bit in August. But I would just say that, as we have retail gasoline prices that remain under the peak that we saw, kind of during the height of the Middle East conflict, then that's ultimately good news. And the other point to keep in mind is again, this is a price level adjustment in energy prices. Certainly that's not good for anybody that's going to the gas station to fill up their car. But just from an inflationary perspective, unless you have retail gasoline prices that are continuing to rise dramatically, the inflationary effects of that one-time price adjustment will wear off. And that's important for next year, because we are getting a boost on headline inflation this year, but next year, actually we'll see, some potential tailwinds as in the case that you don't have energy prices that are continuing to rise. So you have to kind of look through some of these more temporary bursts in inflation. We think, again, this is why the Federal Reserve is remaining in a cautious stance here, ready to hike, but not necessarily in a hurry to do so, waiting to see more data.
Tiffany, stand by for a minute. We're going to go back to Mike and get some more details on what this report had, some of the components. Mike, you've been parsing through this. What stands out to you?
Well, what stands out is one of the things that Tiffany mentioned, and that is airfares. They're up 2.2% in the month after just a 0.2 gain the month before. So obviously the jet fuel price increases are feeding through into that. There are some other areas that do show some inflation. Used cars and trucks up 0.4 after declining the month before. Apparel prices are up 0.1, but they had declined 0.6 the month before. Medical care services also up 0.6 after declining in June. So there are some areas that are peeking through that do show some inflation. And then the supercore, which is basically services ex housing, is up 0.2% on a rounded basis. And that is changed from the 0.2 decline we saw the month before. And this becomes important because the hawks on the Fed are not just saying that the energy price shocks are a reason to be able to raise rates or a reason you need to raise rates, but the underlying inflation is a problem. And they're looking at these supercore kinds of numbers and saying, yeah, there's still some stubborn inflation in the services areas that we have to keep an eye on. So it probably isn't decisive one way or another. We've talked about that because, of course, there's another CPI before they meet again. But this is not unabashedly good or bad news.
Mike, thank you so much for this. Tiffany, what's your take on that some of the components that really reflect consumer discretionary spending power, some of the components that reflect heat in the underlying economy did show inflationary pressures, even with some of the disinflation coming from oil, et cetera?
Yeah, I mean, I think on the retail inflation side, I think you have to be a little bit careful. I mean, any one or two reports can be noisy. Of course, we got Prime Day discounting in June this year, and therefore, you have probably a little bit of snapback in prices, after those, after those discounts in June and July. So I think smoothing through the sort of noise in core goods prices, I think it still looks to us like you're seeing, some good news there. Certainly the, elevated prints that we saw across core goods categories last year and early this year from the effects of tariffs and higher costs related to those tariffs. We think that's kind of fading right now. And then, looking across, some of the, quote, AI impacted categories. So those categories that are having to deal with the higher costs of chips and other things like that related to the AI build out, those categories also, are looking, a bit more contained here as well. So the software category, which has been important for PCE inflation because of the higher weight, that came in a little softer this month. So again, overall, I think you have to take this in the broader context that, we do think you see some disinflation in the back half of this year. Again, in this report does not really change that view meaningfully one way or the other.
Do you think there's anything in this report that can change the minds of individuals we've heard about from the Federal Reserve, like Austin Goolsbee or overnight to the FT? We heard from Susan Collins in terms of how they view inflation going into the September meeting?
Yeah, I mean, so no. I mean, I don't think this is going to change a lot of people's minds either way. I think the broader issue now of just taking a step back is what is the inflation data telling us? We clearly know that we've gotten a series of supply shocks that has impacted inflation / one-off sort of price level adjustment type of shocks. You have energy, as we talked about. You have the tariffs that are fading and some of this AI so-called chipflation, indirect effects from that. But on the other side, so that's if that's driving inflation, those are sort of temporary factors. Monetary policy works through long and variable lags. The Fed will want to be careful. But on the other side of that, we also know that we are seeing some wealth effect in the U.S. economy that's boosting demand and keeping U.S. growth resilient. So if you're seeing inflation that's being supported more by this resilient demand growth in the U.S. economy, then that's more concerning for Fed officials. We've seen inflation that has been above target for clearly for several years now, and they will want to get it back to target. And so if this is really demand-driven inflation, then that does require more of a policy adjustment. But again, I think there's some uncertainty around what's exactly driving this, and Fed officials will want to see more data. I think the other thing that's important to note here is just that the labor markets, sort of looking comprehensively at labor market data, at wage data, labor markets are clearly not the source of inflationary pressures here. So as I mentioned, that the sort of resilience in the economy is more related to a wealth effect that's happening as opposed to that labor market overheating.
Tiffany Wilding of Pimco, thank you so much for being with us this morning as we break down these numbers. CPI coming in at bang in line. The details a bit interesting. Right now we are seeing in equities a surge up, a sort of pop up in equity futures. Michael McKee back with us for a final note. Mike, you've been parsing through. Oh, what's the latest?
A couple of little interesting things here, Tiffany, and you were just talking about AI and the rising expenses there, and we do see a big jump in the price level of computers, smart home products up 3.5% on the month. Computer software up another 0.5%. So we've got some AI impact in there, perhaps. We also have toys up 0.8 after a 2.5% rise in June. And this is when companies are ordering toys from China to get them here in time for the holiday season. So that might play into some holiday price increases. And finally, whiskey at home up 0.9. Whiskey, one of those areas that has been tariffed. So maybe there's a tariff impact there.
Michael McKee, thank you so much. Right now in markets, we are seeing a lift in equities, more of a reaction actually in equities and even bonds, with the S&P 500 now up about 0.5% and the NASDAQ up in the pre-market trading up more than 1%. Up next, David Kelly of JPMorgan Asset Management as markets take the inflation data in stride from New York. This is Bloomberg Surveillance.
This plus the softer CPI print last month, has to be, a little bit of a relief for Fed officials. Some of the more hawkish members on the committee, we doubt it really changes their minds. So, I don't think this really resolves a lot. I think our lean is still that the Fed remains on hold in September. We'll just have to keep watching and waiting.
That was Tiffany Wilding of Pimco. If you were looking for a clear answer from today's CPI data, well, unfortunately, you do not have one. And we are back to clear as mud when it comes to the trajectory going forward, with people saying that this is a one-off blip, other people saying that we will get some sort of protracted disinflation. Either way, it has been positive for equities, with NASDAQ futures up almost 1%, S&P futures up 0.5%. You could see in the 2s, 10s, and 30s. That bid into bonds continuing, although fading just a bit from earlier this morning. Although notably at the front end, that is where the rally is currently. Two-year yields lower by almost 4 basis points, 4.18%. On the long end, also still lower by about 3 basis points in the 30-year to 5.21%. Counting down to the opening bell, here is the trading diary for the week ahead. 1 p.m. Eastern, the U.S. Treasury auctioning $42 billion in 10-year bonds. Thursday, PPI data, jobless claims in the 30-year auction, followed by Fed speak from Beth Hammack and Tom Barkin. And on Friday, we get retail sales and the University of Michigan Consumer Sentiment Survey. If you are just joining us, we got a bang-in-line CPI print. Headline CPI year-over-year 3.4%. Core coming in at 2.5%. David Kelly of JPMorgan Asset Management joins us now for more. David, wonderful to see you. Thank you for being here. So what's your take on this bang-in-line CPI print? You can see under the hood, there's disinflation coming from energy, and there's some inflationary pressures coming from housing and elsewhere.
Well, first of all, when you look at an employment report or a CPI report, the truth is CPI is almost always what the analysts think, because we have a lot of data going into it, which just makes it very hard to have a big surprise. So not surprised that we're not surprised. Having said that, I think there is a clear disinflationary trend. There are a lot of cross currents, a lot of cross waves in the data this morning. You know, things like airline fare is up, but tobacco prices, not moving as much as it did last month. Differences in medical commodities and services. But beneath it all, I think there are a few things to bear in mind. One, we're going to have lower tariff costs going forward than we've had a year ago, because the new tariffs are not going to fully replace the IEEPA tariffs. Second, I do think that eventually oil prices will come down, because eventually there's only one solution to this thing, and everybody's always got to get out of the Strait of Hormuz, and I think it will. But the biggest thing to me is this is the fourth consecutive month in which wages have gone up by less than CPI inflation. 3.2% year over year on wages, 3.4% on CPI. And what that tells me is American workers can't get a raise. And if they can't, you cannot have sticky inflation. We've essentially got Teflon inflation in America. It won't stick, and it won't stick because you've got this, you can't get a price-wage spiral going if the wages won't react.
We haven't seen inflation coming from the labor market for a while, though. Yeah. This has been coming from one supply-side shock after another, and there have been many consecutive ones. At a certain point, when does it stay sticky? Like, how do you define sticky? It's been more than 5 years, and so it really hasn't been led by that.
Well, it's been more than 5 years on a year-over-year basis, but it takes about a year to fix a year-over-year problem. That's the first thing. So if you actually look on a 3-month basis, there have been plenty of periods where inflation has fallen below 2% over that 5-year period. It's just on a year-over-year basis. As you say, we've had one supply shock after another, but they've been, COVID and the policy response. We had Ukraine. We've now had the Iran war. We've had tariffs. Most of this is actually, most of it, apart from the Ukraine war, is policy decisions. I mean, the inflation we have right now are policy decisions on immigration, on tariffs, on the Iran war. If we back off, and I would even think that with more divided government next year, quite possibly, we will back off on these things. I think inflation will gradually come down. I think the wise thing for policymakers to do here is just let it happen. It's going to work slowly, and that's just how it's going to be.
When you say policymakers, you mean Fed officials. You think that the Fed should stay on hold?
Absolutely, they should stay on hold. And I actually think they will. I mean, I noticed just after this report, we just saw a further slight decline in expectations for a Fed rate hike. And, every confirmation that we're on a downward path, I know it's not coming down as fast as anybody would like, but you can do no good by trying to hurry this process. There's it's like an injury. It just heals slowly. And if you try and speed it up, you're just going to mess everything up. So we have an inflation problem, which we're going to heal slowly here.
Right. And if the data is coming in either bang in line or a little bit softer like it did last month when it comes to inflation, then why do you see more Fed officials becoming more hawkish?
Well, I think they want to sound hawkish, but ultimately, I think they have a real communications problem. I think that they are on entirely the wrong track by saying we're going to communicate less. And so I think right now there are various.
Well, it's only one. That's the Fed chair.
Well, yeah, but I think it's important that the Fed chair try to reflect the consensus on the committee and tell markets about it. So I think the Jackson Hole speech that Kevin Walsh is going to do at the end of this month, that's very important, because I think at that point he's going to have to back off a little bit from his very aggressive rhetoric and say, admit that and acknowledge that there's some progress in inflation. It's not as fast as we'd like, but there's some progress, and there is a cost to everybody in raising rates if you don't need to do this, and if it's healing on its own.
Do you think that if the Fed did raise rates, that would actually take control of the long end of the yield curve a bit more, that will create a better financing environment, because it could suppress some of the concerns about Fed credibility and longer-term inflation taking hold in the system?
I think it's a close call, because the other thing is that if they do that, then what's to say they won't also then start attacking the balance sheet? And the one thing that's going to push up the long end of the yield curve is if you try and pull down that balance sheet. So I think that would be a kind of mixed message. Ultimately, I think the most important thing in deciding inflation expectations is how long does it take us to get to a settlement in the Middle East, some sort of settlement that allows traffic resumed there.
Does it really matter whether the Fed hikes rates by 25 or 50 basis points? Because pretty much everyone who we've talked to say that the fiscal stimulus that's coming from all the AI companies that keep doing all this CapEx spending is insensitive to where the Fed funds rate is.
It doesn't matter for the economy. It does matter for markets because there's a lot of leverage in the system. There's a lot of leverage bets in financial markets right now. You increase the cost of leverage, that could help the markets, hit a peak and come down. So I think it could, and I'm not saying I think the markets are too frothy, but again, there are other things we probably should be doing to try to rein that in rather than just raising interest rates.
So you think that it really is a financial market response to the rate hikes that could potentially be problematic because of how much leverage there is in the system?
Absolutely, yeah. And if you do hike and you've got higher short-term rates, then the temptation is to move to a little bit more safety, and that could take some of the wind out of the market sails. So that's where I think you'll see the response. Interest rates matter for financial markets. Honestly, they don't matter that much for the economy anymore.
David Kelly, wonderful to get your thoughts. David Kelly of JPMorgan Asset Management joining us here in New York after we got that CPI print. It was the incredible, important print before we get that September meeting. And the read is, this is all in dovish. As we were just hearing from David Kelly, we now have a below 40% chance getting priced into Fed funds future of a rate hike in September. So in line means potentially a reprieve from some of the rate hike bets.
Now the August CPI just becomes a lot more important. And then to David's point, what Chair Warsh says at Jackson Hole.
Yeah, coming up tomorrow, we'll be speaking with Max Kettner of HSBC, Erica Najarian of UBS, Goldman Sachs Vice Chair Robert Kaplan, and Francisco Blanche of Bank of America, taking a look at the oil sector, given what we're seeing with respect to a stalemate in the Middle East. This was Bloomberg Surveillance. Good morning.